Hello, I'm Andy Acapangelo. I'm very proud to be the leader, the founder of a social enterprise. Social enterprises exist because they have a purpose other than just making money for the shareholders. Our purpose is to reform the way the financial sector works and help it to serve society better. We've now been running for over 10 years, which in itself is a bit of an achievement. It's not been easy. And more of our work these days is dedicated to better understanding the way the regulatory framework works. The regulatory framework, what Paul Carlier refers to as the hierarchy of oversight. The hierarchy of oversight being effective is prerequisite number one, if what you want is a financial industry that properly serves society. Because if the regulators, for some reason, fail to hold the industry to account, then it's pretty unlikely we'll have a financial sector that behaves as it should. As many of you know, if you look at data, for example, the data in Violation Tracker UK, you will find that the financial sector behaves worse, according to amounts of fines against it, than any other industry. So there really is reason to be concerned about whether the sector is behaving as it ought to. When it doesn't, it's down to folks like us to call it out and to do all we possibly can to make sure that the industry does behave the way it ought to. I'm going to be sharing my screen just to bring a few points to life, if you bear with me while I get to my slide deck. We are going to be making some direct references to some of the similarities between the PPI scandal, the massive PPI scandal, what some of us might think of as enormous and a notorious PPI scandal. And the reason for doing so is because perhaps there's reason to have a strong sense of deja vu about all this. So tonight's session, as you know, is the car finance scandal, the complete expose. The title says it all, really. Some of the expose has already happened by way of what's previously been reported, and in particular by way of what's been reported through the BBC Radio 4 File on 4 programme that hopefully you've all listened to. That took place on Tuesday evening. But of course, like any radio programme or TV programme, or any documentary, in fact, it's impossible to tell the whole story within the timeframes that producers and publishers and broadcasters have. Today, tonight, and on Monday evening, UK time, Mr. Paul Carlier has very kindly agreed to tell us the whole story. Paul is an absolute gift, a treasure, if you like, to the cause for reforming the way the financial sector works. He is a profoundly high integrity individual with a remarkable ability to focus on the detail that really matters. So we really are grateful to Paul for doing all the work he has been doing. A bit more about Paul in a moment. But here we have it, folks, the car finance scandal, the complete expose. A brief recap on PPI. £50 billion. That's how big that scandal was. £50 billion. It obviously caused extensive reputational damage to the regulators and the banking sector. Of course, that reputational damage will have impacted people's trust and confidence in the industry. And it's obvious that if people don't trust the industry, they are less likely to buy from it. That therefore means that it will have acted on as a brake on growth. We're stressing that particular point, of course, because the current government is highly motivated to achieve growth. And the subtext within our first bullet point there is very simple. Is it sensible for there to be allowed to be extensive reputational damage that inhibits growth when the government has a major policy intent to stimulate it? The two seem to be going against each other, don't they? The FSA and then the FCA were shown to have failed to protect consumers and acted far too slowly in the face of widespread misconduct, despite whistleblower reports they received showing clear evidence of systemic mis-selling. Please do ask yourselves, ladies and gentlemen, whether you're getting a sense of deja vu about what happened in the PPI scandal with what Mr. Carlier is going to be explaining in relation to the car finance scandal. Critics accuse the FSA, the previous regulator, of being too close to the banks and not assertive enough in consumer protection. The regulators were seen to be weak and incompetent, allowing a culture of sales-driven misconduct to continue for over a decade. The FCA's successor role included a mandate for it to rebuild trust and confidence. The FSA basically crumbled for various reasons, including the PPI scandal, and the FCA had a job to do, which was to rebuild that damage that was done. MPs, consumer groups, and the media heavily criticised the FSA and later the FCA for allowing banks to profit from widespread abuse. There was a parliamentary commission on banking standards. It described the regulatory response as timid. Can you have a regulator that's timid and also effective? I don't think so. I really don't think so. The PPI scandal was one of the factors that led to the demise of the FSA. The scandal did become a case study in catastrophic regulatory failure. Do you have a sense of deja vu? What we're setting out tonight, what Mr. Porcada is setting out tonight, is very good reason for these three questions to be asked. Number one, are the financial regulators guilty of the same failings in the car finance scandal as they were in the PPI scandal? We'll come back to that question later. It'll be fascinating to see what you think when we get to the Q&A discussion bit. If they are guilty of the same failings in the car finance scandal as they were in the PPI scandal, what does that tell us about whether they are fit for purpose? And if they're shown to not be fit for purpose, does the car finance scandal pose an existential threat to them? Could what's been going on cause Parliament to lose trust and confidence in the efficacy and perhaps even the integrity of our financial regulators? Ladies and gentlemen, for all these reasons, what we're going to be covering tonight is of profound significance to those of us that want the financial sector to behave itself that's properly regulated. A Transparency Task Force is not into the idea of loads and loads of meaningless regulation, red tape and bureaucracy. We think there ought to be a relatively straightforward rule book for financial firms to operate by. But we also think that that rule book ought to be robustly enforced. We want the regulators to be proactive, to be tough, to frankly, to be respected enough that nobody feels confident that they can break the rules and get away with it. We have with us tonight an absolute subject matter expert on this issue, and frankly, many others as well in this space. I've known Paul for many, many years. These aren't just words when I say that we are extremely fortunate, all of us, to have somebody in Paul who does so much work on a completely pro bono basis to shine a big, bright light on shortcomings in the system. Paul is highly motivated. He's a very high integrity individual, a phenomenal grip of all the detail. And I think we're blessed to have him in our community. I'm going to be passing over to Paul in just a second. But before I do, please join me in thanking Paul for being Paul. I think he's pretty unique. And I think he's just absolutely fantastic at what he does. Paul Carlier, thank you very, very much indeed. Please do join me, folks. Paul, over to you. Take it away, sir. Thank you very much. Thank you.
Okay, so what we're going to do tonight, we're going to play the BBC Radio documentary from the other night, and I'm going to pause it at various times in it to give some context, to share some of the documents that were referred to, give my rebuttals to certain statements made by, let's just say, rather skewed individuals from on the side of the industry, and to share with you some stuff that didn't make it into the BBC documentary for whatever reason. I imagine Lloyd's, Black Horse, the Ombudsman and the FCA were kicking up quite a fuss, as you will probably understand when I share some of this evidence with you. So I'm going to try and share my screen now. Before I start, I want to we're calling this the true car finance scandal. What is the true car finance scandal? It is not the scandal that you all believe it is, or the industry and the FCA would have you believe, that is now going to see 15 billion paid in redress to millions of consumers, and that is regardless of the Supreme Court decision. Don't fall for the smokescreen and the narratives that are being spun by the lenders, their cartel trade bodies, and their lawyers and PR firms, that the Supreme Court judgment is everything. It's an all or nothing. If the Supreme Court overturns the Court of Appeal, that it will also overturn the Ombudsman decisions last year and the decision of the High Court. That's nonsense. The Ombudsman decisions and the High Court decision that was upheld upheld in the High Court last year is specific to the incentivised commission arrangements. Those were deemed unfair and unlawful in a breach of the Consumer Credit Act, and that is going to give everybody the redress, or should give everybody redress equal to the difference between the amount of interest customers paid on the APR they got and the interest they would have paid had the lender, had the dealer put the agreement through at the lowest APR within the generic APR bands that they gave the dealer to work within, and that the customer didn't get but for these incentives, right? That is entirely separate, and that is going to deliver about 15 billion in redress. Now, so don't believe the nonsense about the Supreme Court decision, it's be all and end all, because the Supreme Court isn't opining on that particular issue. And if for the Supreme Court to overturn that, they would have to go back and overturn their own decision in November 2014 that is specific to the Plevin versus Paragon case, which is the so-called PPI case. Right now, that decision basically determined that a financial product cannot be priced on a whatever you can get away with basis in the interest of greater revenue for the parties involved, right? Which is exactly what was going on in car finance. That's completely separate. So this redress is going to, this will remain, right? The Supreme Court's ruling on whether an unfair relationship, disclosure, non-disclosure of commissions at all, that kind of thing, right? So let's not muddle the two. That's what everyone wants you to believe. Right, so before I play the documentary, I'm going to just show you this first slide. I don't know if you can all see that slide and the photo in there. Basically, this, in September 2011, my mother-in-law was sold a car finance agreement by a local dealer with Black Horse, and the APR on it was 14.9%. Now, she was somebody that had a perfect credit score, right? She's that generation, well, never miss a payment, very, very careful, very modest credit risk, etc. 14.9% made no sense, because obviously the higher the better your credit score, that doesn't just determine whether or not you get finance or approved for it, it also determines your APR. We all know about subprime. Subprime is, if you're a big credit risk, you end up paying a much higher interest rate. Well, it works in the opposite as well. So if you've got a perfect credit score, you should get a better APR, right? Because let's not forget, these are all sold subject to status, and your status is determined by your credit score. So now I want you to make a note of this date. 21st of May 2012, and I don't know if you can see the line there, it's not the best picture in the world, this is from a very old DSAR from Black Horse. 21st or 22nd of May 2012, I logged a complaint with Black Horse specific to the interest rate and the APR that my mother-in-law get. It's 13 years ago. Black Horse denied the complaint, said it was appropriate rate, and at the time I had no evidence whatsoever to disprove it. I just knew that this was absolute nonsense. That was not an appropriate APR, but couldn't, I didn't have any evidence to hand to prove it. So I'm going to start the documentary now, and then I'll be interjecting as we go. So this is the documentary that aired the other night.
Did you take out a finance agreement on a new or used car between 2008 and 2021?
If you've been scrolling social media recently or listening to your car radio, the chances are you've probably heard some of these.
Ever mulled over the possibility of being a victim of missold car finance? It can be a daunting realization. But
Did you know these car owners could be entitled to thousands in compensation and they have no idea? because that's exactly.
Almost everyone will know someone who's had one of these deals, who's put in claims and is waiting for the outcome. You might even be one of them yourself. The industry and the government are worried about the possible impact on the markets of this and an upcoming legal judgment, with the highest estimates saying the compensation bill could hit more than £30 billion. So just what has been going on and what does it mean for those of us who buy cars on finance? I'm Helen Katz, I'm a BBC correspondent, and together with my producer Phil Kemp, I'm going on a bit of a road trip to find out, in a story that goes all the way to the Supreme Court, but started on the garage forecourt. Hello, Estelle. Hello, Helen from the BBC, Phil from the BBC.
Hello, welcome to EV Experts.
I mean, when you said you were on the A3, I didn't realise you meant you are literally on the edge of the A3.
We are literally, and ironically, this used to be the site of a petrol station, and now here we are selling electric cars from it.
Can you take us for a ride in one?
Absolutely. What do you fancy?
Estelle Miller and her husband opened their dealership in Surrey in 2017 after struggling to find an electric car to buy themselves. She says researching the industry threw up some surprises.
The overwhelming thing was that everywhere we went, be that a small forecourt or a large dealership, was that talking about the finance product that they would like you to sign up to was the first conversation. It led the conversation rather than the car itself.
Why is that? Is that because that's where they're making the money, or what is it?
Yeah, definitely, because that's where the revenue is coming from. That was the most shocking thing that we found.
Nowadays, 9 in 10 of us who buy a car borrow from a lender to do so. It's the biggest lending market in the UK after mortgages. Back in the showroom porter cabin, Estelle told me what she discovered about the way finance was sometimes sold.
At that time, we were seeing things like different APRs being offered. So at that time, retailers could adjust the APR on your finance product as part of the negotiation, which again just didn't sit right with us. We also saw cases of two prices being offered. So if you buy the car on finance, I can give you a discount. If you don't buy it on finance, then it's going to be a couple of £1,000s more. So when we set up, we made an active decision to put the product and the consumer first. And the financing arrangements were more logistics, if you like, on once the product had been chosen, how the person would get to own it.
These days, she says, thanks to changes in the rules brought in by the regulator in 2021, the process of borrowing to buy a car has become a lot more transparent and time-consuming as a result.
When we first started offering finance, you would see people driving away on the same day fairly comfortably. I'm just not seeing that anymore because the amount of information that they have to give and provide to the lender. In fact, you saw that today when you arrived today. The people who were here when you got here, they've decided to buy a very lovely electric Mini. That's on finance. We've given them all the information they need at this stage. They've now gone home, and during this evening and tomorrow morning, they will receive more and more information and will be interacting with the broker and the lender. And the likelihood is that they'll be collecting their car tomorrow afternoon or the day after.
Right, I just want to interject at this point because, I mean, it's a great approach from this particular dealer. You know, they've identified flaws, so their model is slightly different. Now, she's suggesting though that this is a problem that somebody's coming to their garage today and they can't drive, and the new rules mean they can't drive away today, that they'll have to come back tomorrow or the day after. I mean, I don't see how that's a problem. Because unless you're there and you need that car to get to an emergency appointment at the hospital or other reason, you can wait 24 hours or 48 hours to buy a car. And you should have to. This is a highly regulated industry that's got certain rules and it's got all these procedures that have to be followed. And it's the biggest commitment by your mortgage that you're likely ever to commit to. So if it takes 24 or 48 hours and it means that the process is going to be fair and lawful, and it means that you're not forced into something, and let's not say, if you can drive it away the same day, how much more tempted is the customer to just, sign, I can have that car now. It's a much more sensible way of doing things, and it won't damage the industry. You just go in today and you pick the car up tomorrow. That's the way it was always done, right? It's, everyone needs to, this is not an issue. This is not an issue, and it's actually good for the industry.
Wayne Gibbard is a partner with the law firm Shoesmiths and has worked in motor finance for 25 years. He says that period has been one of incredible growth.
When I started, around 10% of customers would use finance to acquire a vehicle. These days, for new vehicles, it would be around 90% for most manufacturers.
Oh, so that's quite a change.
Yeah, absolutely. And we've seen that growth in volume, but also, in terms of value. So the sector now is worth around 50 billion a year. It's a huge sector, and clearly it's an enabler. So it allows people to get into vehicles and to fulfill their life. So be that work, be that their home life, to take people to hospital or to sporting events. It's clearly a key part of the economy.
Right. I want to take issue with this lawyer that defends and acts on behalf of lenders. Now, he's pitching this as, oh, the industry, they're enablers. This is great. We're doing a great service to the country, right? Because we're providing people with cars, and everyone needs a car. Yeah, we do. We all need cars. But let's not forget, you and your clients have unlawfully profited by way of various unlawful and sometimes, if not criminal practices for over a decade, and generated for yourselves billions of pounds of additional profit that you weren't entitled to, right? So let's not all give us this, aren't we doing stuff for the greater good here? This was all about pennies in their pockets. And let's not forget that the billions of pounds that ended up into the bank coffers was taken out of the pockets of UK consumers, directly out of our disposable income, and that could otherwise have been spent elsewhere in the economy, generating greater growth and greater VAT receipts as a result. And we all know that when profits are diverted to the banks, it's where money goes to die, right? It gets recycled to shareholders and offshore as opposed to back into the economy. So this lawyer, his moral compass he's making representations that are not consistent with the actual moral compass of his clients. So let's not, they have profited. They're in the wrong here, right? There's nothing good. There's nothing morally, great or servicing the country. That it's just another disingenuous, if not dishonest, narrative. And they're all at it. All the lenders and their trade bodies.
According to the rules set down by the regulator, a dealer has to be crystal clear with a customer about any commissions they're getting from a sale. And there's one type of commission that's been banned. Now, I've jumped in the car and I'm heading over to Kent to hear from a man who found out about that practice almost by accident.
Hey,
Good to see you. Is that all right? I've just left my car around the corner.
Yeah,
Is that going to be all right?
yeah.
Brilliant. In a village in the west of Kent, former city trader Paul Carlier is a man who's been on a mission for more than 10 years.
I'll get you a fee or coffee. Yeah. Obviously, it starts with one folder, but very rapidly expands. You've got audio files, you've got video files, and obviously the vast amount of documents, PDF files, Word documents, etc.
Can you show me? In fact, there are so many files that sitting on his desk are 2 computers, the second purely for storage. Paul freely admits he's a bit obsessed with this. He tells us that's partly because he's on the autistic spectrum, and he laughs as he says that his nickname when he worked in the city was the Romford Rain Man. And car finance isn't his only crusade. He's blown the whistle in other areas of financial services. On his desk is a pale blue notebook with a cover that reads, "Times I was right and nobody listened."
You start pulling at the thread, what starts out as a single thread soon becomes a sweater.
Paul suspected something was wrong in the car finance market when his mother-in-law, who he says had a perfect credit score, was charged a high interest rate. But it was an encounter with a car dealer who was selling his wife a car in December 2015 that he says explained why.
It was pure chance. We were looking to get a decent deal, and a friend of mine introduced me to a car dealer in Essex, typical Essex car dealer. And so we went to see him. He had a nice Mercedes and offered her a finance agreement of, I think it was 8.9% APR. So literally off the cut, I just said, "Oh, this is better than my mother-in-law got." And he said, "Let me guess, 14%?" And I said, "Yeah, well, how could you possibly know?" So he said, "Oh, yeah." And then he just proceeded to spill all the beans to me.
What the salesman told Paul was this. In many cases, finance companies were giving dealers a range of interest rates that they could offer their customers, but it was up to the dealer themselves to choose the exact rate, and the higher the rate they set, the more commission they made. They were known as discretionary commission arrangements, or DCAs for short, and they were the industry's dirty secret.
I mean, this meeting was quite extraordinary because whether my jaw actually hit the desk when he's told me how all this is going on, and you know, he literally told me everything, and then even turned his computer around to show me how the system worked. And I'm saying, but you're the dealer. You're the dealer, the agent, the broker. You never get to price a financial product, right? In all my years in the city, that's never, you know, the broker doesn't set the price, right? The two counterparties set the price if it's two, you know, and if it's a lender, they set the price, right? And then what he told me was that, and the slide here rather describes it, that Black Horse set him a wide APR band to work within, about 10% wide, right? They then tell him, and only him, fire away, you set the APR. So the dealer puts every detail about the customer, the transaction, the car, the price, everything into the system, and the dealer just picks the APR. And at the point he presses the button, Black Horse know as much as he does about the customer, the car, everything. However, upon pressing the button, Black Horse do the processing of the credit score. They never, and this is critical, they never shared the information about the customer's credit score with the dealer. Now, that creates another can of worms, because these are all sold subject to status, right? So as you've all heard that. That's saying, you see it on advertising, credit sold subject to status. Your status is generally determined by the credit score obtained from the credit reference agencies, right? And again, whether or not you get credit depends on that. And the APR you get is appropriate to your status. The higher the higher your credit score, the lower the APR you should be, you should be available to you, and vice versa, right? So that, and I'm gobsmacked. And then he told me, and the higher the APR I set within those bands, the more commission for me. And it was like, oh my God, that's a breach of the Consumer Credit Act, and that it was specifically contrary to the Plevin judgment in the Supreme Court in November 14, the one I mentioned earlier. This is the so-called PPI judgment that Andy's referred to earlier, that delivered billions in redress. And again, just to remind you, that judgment, and very broadly summarised, said that it was a breach of the Consumer Credit Act and various regulatory codes to price a financial product on a whatever you can get away with basis in the interest of greater profits for the parties involved, right? That's exactly what's going on here, right? Absolutely unlawful and breach of codes, as well as as well as the Consumer Credit Act. So I'll carry on playing again.
And the finance agreements that customers signed were sometimes, let's say, a little coy on the subject of commissions, as my producer Phil found out.
Right, so I've got a copy of a finance agreement here, which I'm going to read through and see how long it takes to get to the bit about commissions. It's quite a long document, this, and I'm expecting it to take a bit of time. So I've poured myself a glass of water here, which I'm going to sip from time to time to keep me going. So here we go. Use of your information. Our use of your information. A.
We will keep a record of personal information about you to help us to improve our service to you. Will not have any rights under or in connection with it.
F. We may pay commission to a supplying dealer or other intermediary who introduces a customer to us. So that's it. That is section 10F of this agreement. Finally says, one sentence, we may pay commission to a supplying dealer or other intermediary who introduces a customer to us. That is taking quite a long time to get there. Something like 28 minutes of talking.
Back to Paul Carlier. He had already complained to the lender once, but he tried again, and he escalated it to the Financial Services Ombudsman.
Right. So basically, I raced home from that car dealer. Right, I've now got the evidence to prove it. I know now what's going on. I know why my mother-in-law's APR was so high. So I submitted a complaint to Black Horse. And on the 19th of January 2016, Black Horse responded to that complaint and not to put too fine a point, they just lied their arse off. They denied that these incentivised arrangements existed. And they absolutely claim, if you look at this actual, that part at the bottom there is an actual part of the complaint response, and it says, "I can confirm that your APR was determined by the score that was obtained from Experian." Absolutely false, right? Because the dealer set the APR, and the dealer had no knowledge of what that credit score was. Only Black Horse did, right? So they have made a false representation there. Now, the Fraud Act is quite clear: fraud by false representation with intent to make financial gain or cause loss or risk to another. So not only have they missold this agreement, they've now lied to me, made a false representation in response to my complaint. So I then escalated it to the Ombudsman on the 16th of February 2016. So here's the actual complaint form that I escalated to the Ombudsman, and don't worry about reading this next slide in detail, but and it's not formatted like that when I sent it in. It's just when you get a copy, that's what it comes out like. But I outline everything in this to the Ombudsman. I tell them what they're doing, and I also reference the false representations that they've made in response to the complaint. So that I'm not going to go into great detail about the Ombudsman at this stage, and the reason for that is that of all the egregious conduct by the lenders and the FCA, that in this true scandal, it's perhaps the role of the Ombudsman that is the most disturbing and shocking. And I'm going to cover all of that in much more detail on Monday. And honestly, you don't want to miss this, because everyone believes the Ombudsman is there to be independent, objective, and be our lifeboat for consumers if something goes wrong, right? Yeah, think again and you'll understand why on Monday. So I'm just going to carry on with the documentary now.
But he was so concerned about what he'd heard that he also told the regulator, the Financial Conduct Authority. He thought it was wrong because the rate could be set based on what the dealer could get away with, not what the customer was entitled to based on factors like their credit score. It's clear the FCA understood exactly what he was claiming, because we've seen an internal email dated the 24th of February 2016, which confirms it.
Consumer was informed that dealers are given a band of interest rates to offer consumers and encouraged to apply high interest rate. The employee confirmed that the dealer gets more commission if they apply a higher interest rate, which is not in the interest of consumers. Consumer believes this is very unfair, as firms authorised by us have a duty to provide the most appropriate product to consumers. Consumer is concerned this is a normal practice in the industry, which is unfair.
Now, that email that has just been read out there by by an actor, that email, I'll come to that shortly. But on the same day I escalated the complaint to the Ombudsman, I submitted this email to the FCA whistleblower team. And as you can see, I bring it to their attention, and I outline exactly what's going on, and that it's the practice, and the fact that this is a widespread practice, and I'm making a whistleblower disclosure specific to this practice. Now, this is really important because PIDA, the Public Interest Disclosure Act, says that you are a whistleblower if you are an employee or former employee, right? So the FCA, I was a former employee of Lloyd's that owned Black Horse, right? This was all going on during my time of employment by Lloyd's between 2012 and 2014. Okay, now, so this is a whistleblower disclosure. Now, the FCA knew me. They knew me well. I'd been in touch with them. I had my own whistleblower case against Lloyd's going through at the time, and I'd had reams of correspondence and phone calls with the FCA throughout 2015 in respect to what was going on there. So they knew me. They knew how experienced I was. They knew I had 28 years experience as a financial markets trader with many of the world's largest banks. They knew I knew my stuff. And you can see here, I detail this. The FCA whistleblower team member confirmed that he had forwarded this on to the relevant department. And on the 24th of February 2016, I got a call from that relevant department, right? I'm going to play two extracts now. And this is literally what I told. This is the conversation I had with the FCA employee that called me on the 24th of February after they had received the email that I'd sent in.
That you're saying, I will make a note of everything that you're saying, and I can pass this on to my colleagues that actually supervise Black Horse to consider. I'm not sure you're aware, we don't have the powers to look into individual complaints. That's the role of the ombudsman. So you've already taken your complaint.
I'm blowing the whistle here.
Yeah, okay, sure.
There is a widespread fraud because they provide this facility to all these dealers. Some are authorised by the NCA, some aren't. But the fact is, you know, these finance agreements are all sold subject to status, and the status is what determines not just whether or not finance is approved, but also the APR on that finance agreement. Okay, that's not disputable. That's how the markets work. That's how responsible anything is sold subject to status improve the APR. That's how people's mortgage rate is decided. You want a higher loan to value, you pay a higher interest rate. You've got poor credit history, you pay a higher interest rate. If you have a better credit rate, the most appropriate property is one with the lowest interest rate. Now, records will not disclose what standard interest rates were available to the dealer at that time. The dealer relied heavily on equips and Connect system with live. And I had a conversation with the phone on February the 2nd, and he just flatly denied they offer these systems.
Sorry, can you just confirm again where you got the information about the fact that the dealers use the banded interest rate?
I got it from a former employee initially of SMC, and I spoke to 2 other car dealers at different locations in the UK. So, yeah, basically, and the key here as well, this is the most important thing. Higher interest rate the dealer applies, the more commission the dealer gets. Now that is outrageous. That is profiteering, you know, unlawful, and absolutely showing no regard for status.
Right. So this call took place on the 24th of February 2016. I couldn't be clearer. I spell it out to her how this whole scam is working, and you clearly hear me say this is unlawful, because it is unlawful. I know the Consumer Credit Act, and obviously we got plebin, so I'm literally spelling it out to her, but I'm also saying this is how they're doing it with all of their dealers. This is not an individual complaint. Now, if you think that part of the call's incendiary, it's this next part of the call that is, I mean, I didn't find these call recordings until December last year, because I got all the written stuff that I'd sent to the FCA, and I was thinking, oh my God, I wish I had the recordings of the calls that I'd made to them in 2016. And it occurred to me in December that, hang on, in February 17, I got a DSAR response from the FCA, and in there was a memory stick that had multiple call recordings on it. And I'd never listened to them. I just figured it was all my calls to the whistleblower team in 2015 about my personal case. So I just thought, maybe they're in there. So I fired up the old computer, found that memory stick folder, went through them all, and sure enough, there they were. And obviously this is later in the same call. You really need to listen intently here to what I say on this next part of the call.
Because we don't have the powers to look into individual complaints, we wouldn't be able to provide feedback on this particular issue. That's something that none of us would be able to do.
No, I'm blowing the whistle here on fraud within the industry, so I would expect, you know, to be kept up to date with what if action was going to be taken in this action, because this is in the public interest. This isn't just in the interest of my mother-in-law. That's been taken care of by the ombudsman. My formal whistleblowing disclosure in the public interest made under PIDA, okay, the Public Interest Disclosure Act. So, you know, it will be a requirement of the FCA to disclose actions taken, because I'm just sick and tired of this country and people being ripped off by scum like this.
I mean, I appreciate all of that. You feel we're obliged to pass that information on. I do have to let you know, however, that in general, we don't normally pass that information on.
We have to, because this is made in the public interest. So you can't, there will be no withholding of facts here, because millions have been subject to this scam. Millions. So if the FCA doesn't act and doesn't disclose it, you are going to allow more millions to be conned in the same way in the future, and B, prevent proper redress for the people who have been conned in the past. The FCA has to do something. The FCA has to make the public aware of what's been going on.
I mean, I couldn't have spelled it out more clearly, right? And I say, well, millions have been damaged by this, and if the FCA doesn't act now, then you heard me say it, then A, millions more will be damaged, and B, those that have already been damaged won't get the redress they deserve, and that the FCA has to let the public know what's been going on. Now, at the time, and this is really important, at the time, my allegations were, and to the Ombudsman as well as to the FCA, that this unlawful practice qualified my mother-in-law for redress that was equal to the difference between the interest that she paid on the nonsense, outrageous 14.9% APR that she got, and the interest that she would have paid had the dealer given her the lowest rate in the APR bands that Black Horse were prepared to lend her. In this case, it was actually 3.9 to 14.9%, right? So that's what I was arguing. Now, you've all heard, and you've heard on that in January last year, the Ombudsman upheld two decisions, one against Black Horse, ironically, and the other against Barclays, and they determined that this was unlawful. This was a breach of the Consumer Credit Act, and those consumers were entitled to, guess what, in redress? Exactly what I'd said my mother-in-law was entitled to 8 years earlier, right? So, how did it take so long and why? But as you can see, right, in the documentary, they read out what that individual at the FCA, she recorded as being what I had reported to her on the call. And here's the actual email that was read out in the documentary. She nails it. She gets everything that I've reported, right? The only thing that is wrong here that is she refers to me as a consumer, right? I was not a consumer, and she said it was unfair. Yes, it was unfair, but I went further because it's true and said it was unlawful, right? But you can see she nails it. She summarized it. She gets it. She understands it. And on a later call with this same employee in May, she confirms that she's forwarded everything that I've sent in to the FCA supervision team for Black Hawks. So there's none of this nonsense that the FCA spouted about LC&F, that 2 million scandal, where they claimed, all 600 reports to the contact centre never made it to the relevant department. This person confirms to me on another call in May, she shared all of this with the FCA supervision team for Black Hawks. That's where the experts sit. Those are the people that knew this was unfair and unlawful, right? So,
Give me, Paul, just to cut in. The ground you're covering right now is absolutely critical to everyone's understanding about the importance of this. What Paul's basically saying is the FCA knew and understood precisely what Paul explained.
I guess what I told the FCA on that call on the 24th of February 2016, right? And now, and at the time, if the FCA had acted at the time in 2016, chances are 3 to 4 billion in redress. But now, because they wait till 2024 to do exactly what and agree with exactly what I told them 8 years earlier, the redress is now 15 billion. And now the industry's going, oh, that's a disgrace, and it makes us, the UK, uninvestable and everything else. Well, hang on. First of all, message to the industry, if you hadn't committed the unlawful acts in the first place, there'd be no redress scheme. You can't bemoan and cry about, the impact on you and the impact on the UK when you're the ones that committed the acts in the first place. I mean, just absolutely ridiculous.
Paul knew the FCA couldn't deal with his individual complaint, but by that summer, he says he still didn't know what their investigators were doing to look at his complaint about industry practice more generally. An internal email from the 3rd of August 2016 that we've seen shows the FCA describing Paul as a persistent consumer who had provided no evidence to substantiate his claim. It said they were looking to close down further communication with him.
Right, now, this is really important as well because, right, I mean, this slide I've got on my screen here, in April, the Ombudsman I'd heard nothing from the FCA, and the Ombudsman had come up with 2 different reasons to deny the complaint I'd escalated, and each time I'd had to go back and prove that that was nonsense. Now, what you see here, I literally got my biggest and best crayons out, and I spelt it out to them as fact 1, fact 2, fact 3, and laid out everything. And at fact 30, right, I summarize the practice. I summarize everything, right? So just so we're clear. Now, this was received by the FCA in April as well. So, and the same person I spoke to, she called me back again in May as a result of that email, again, confirming that she'd passed this big best crayons document to the FCA supervision team, right? So they had everything. Now, the email that Helen refers to is shocking. Now, this is dated the 3rd of August. Now, bear in mind, 6 months earlier, that FCA person I spoke to, she nailed it. She summarised everything. But here, they're pretending that, oh, you know, it says here, like, you know, it's so, we're looking to end all communication with him. He's written to us over 30 times about an ongoing dispute with Lloyds, which he's had rejected by the Ombudsman Service. That's false. I just copied them in correspondence, as well as directing correspondence to them, because obviously the 2 things are running parallel. My mother-in-law's complaint and the FCA whistleblower disclosures that I'd made. Now, he says here that, you know, his first didn't provide us an understanding of what his actual concerns were. The end of that first paragraph. Now, what this is, and I'll go on the record here, so if Mr. Cross, the press officer of the FCA is listening, Mr. Rathie or Mr. Alder, you're listening, right? This is the FCA MO when they want to bury something. They dishonestly reinterpret something, pleading ignorance as to what it is that you've alleged so that they can shut it down, right? And this coincides with Andrew Bailey's arrival at the FCA. Now, I'll touch on this another time as well, but Andrew Bailey and Megan Butler arrived at the FCA from the Bank of England in 2016 with what we now understand from a former FCA senior manager to be a mandate from government, no more redress schemes, no more. It's not good for it. It's not a good look, so no more historic stuff. So what part of that mandate from government and Treasury went into that email? Because you can clearly see that he's lying in that email. He's claiming that I didn't tell him anything, and they're saying that we've exhausted all they're going to shut me down. Now, they never contacted me to tell me this. So all this was unbeknown to me. They'd taken this decision internally. They dishonestly reinterpreted what I'd reported, made it seem like there was nothing, and shut me down without actually telling me. So, I mean, it's extraordinary. It really is.
Frustrated at the lack of action, Paul took matters into his own hands and turned amateur detective.
Oh yeah, hi. I wonder if you can help me. I'm just making some initial inquiries at the moment. I'm in the process of setting up a new used car dealership in Kent, and
Posing as a new car dealer, Paul rang Black Horse, the car finance division of Lloyds Banking Group. It's the largest player in the market in the UK. We should point out here too that Paul used to work for Lloyds in a separate division and successfully took them to an employment tribunal for unfair dismissal. But he showed us evidence he'd first complained on behalf of his mother-in-law before any of that happened. Now, first of all, Paul gets the call handler to confirm they set the boundaries for the APR, the cost of borrowing over a year, with a lower and an upper limit. We've changed their voice to protect their identity.
Okay. And in terms of APR, I mean, does it work in the same way? You set us a band of APR to work within. Is that the? Okay.
Then he gets them to confirm it's the dealer who fixes the APR to be paid, not the finance company.
Okay, so it's entirely down to us to determine the APR for any transaction.
And is it possible to sort of, if the customer gets a bit funny about an APR, is it possible we can go in and if we set it at say 13% and to close the deal we might need to go to 10, can we go back and change the APR ourselves? Okay.
Then they discuss how lowering the APR the customer pays could affect a dealer's commission.
If we have to really go cut it to the bone to close the deal, I mean, does that affect our commissions in any way? Right. Okay, so, I mean, that's fairly standard. The higher the APR, the greater the commissions and vice versa. Yeah. Okay.
Paul says that bit is key. It's confirmation from the call handler that the higher the rate the dealer sets, the more he would earn in commission. We know the FCA received the recording Paul made because another internal email from the 8th of September 2016 that we've seen confirms it. But it adds that the regulator's contact centre has by this point closed contact with him and notes that no direct question has been asked of us. The team did ask another department if they wanted the contact centre to take any action, but it's not clear if they did.
It's very simple for me. Everything's kind of black and white. It's right or wrong. And what more could I do? And the frustrating thing, I mean, I know this stuff inside out. I was FCA authorised and regulated. I worked in these industries. We had to do mandatory training every year. We had to pass FCA regs exams. So you feel like you're banging your head against a brick wall. Right. I'm going to show you this email. Now, the significance of this email is that because basically I did the recording. It was like, enough's enough, right? The Ombudsman had denied the complaint for a third time, claiming that there was no evidence that these systems exist and there's no evidence that the dealer could manipulate the APR. I mean, it was just nonsense. So, okay, I'm going to go undercover. I'm going to call Black Horse, and I had a little script prepared. If I pose as a car dealer currently using one of their competitors, maybe they'll spill all the beans to me on the call recording to try and nick business from a competitor. And they did. They spilled every bean. Now, what you don't hear is that after this guy confirms everything, I waited a while and called back again to the new business team, hoping to get through to somebody different, which I did. And I ran through the same thing again, and they spilled all the same beans. So there can be no question here that, oh, it was one person misspeaking. I got two sources from Black Horse, and I sent this email here to the Ombudsman and the FCA on the 7th of September. And it was like, right, there you go. There's the evidence. Now uphold that complaint. And the FCA, what more evidence do you need? Right. So that's the first part of the email. Again, I spell it out what those recordings are showing. And it's the second part of the email there. Right. So you now have irrefutable proof that this complaint must be investigated again and the decision overturned. You cannot say that I have not provided new evidence or raised new points. Right. I mean, and the email that Helen refers to now, obviously the FCA, if you go back to that first, you can see I copied the FCA in on this email, right? Now, and they received it. And here, this email on the 8th of September is somebody internally forwarding it on. And he opens it as discussed. Please, so they've already talked about this. They've already talked about this email and what's attached. So he said below where he's included 2 phone calls about his concerns about Black Horse. As you're aware, we've closed contact with Paul Carlier about this matter, but please let us know if you want us to take any action on this email. Now, he's clearly listened to those recordings. Now, he's not asking if they want to take any action because there's nothing on those recordings that warrants any action. He knows that those recordings are incendiary. He knows that this proves everything I've alleged. There's no two ways about it. I mean, you cannot listen to those 2 recordings where they spill all the beans and not conclude, oh my God, this is a breach of the Consumer Credit Act and obviously Plevin, right? So, but what's really interesting, and this is the FCA way, look at what Harry closes it. We've only been copied onto this email and no direct question has been asked of us. So in other words, saying we've got a way out if we want to bury it. That's essentially how I read that. You know, it's the FCA way. There's an escape route here. And obviously they did nothing at all.
But then in April 2017, more than a year after Paul had first raised the alarm, the FCA announced it was going to do some exploratory work on car finance and commission arrangements.
Right, I'm going to stop it again there because
the FCA is spinning this spiel that their review that commenced in April 2017 and concluded 2 years later was just an exploratory piece of work. It wasn't an in-depth investigation, yada, yada, yada. Well, that's nonsense, because this is from the FCA business plan for 2017 and 2018. Now it says, motor finance. We are concerned that there may be lack of transparency, potential conflicts of interest, and irresponsible lending in the motor finance industry. We will conduct an exploratory piece of work to identify users of the products, yada, yada, yada. But look at the bit I've highlighted in bold. Following the review, we will assess whether and how to intervene in the market. So it was always with a view to intervention or enforcement action if necessary, right? And obviously, they already had my smoking gun intelligence, and then they did a 2-year review where they had to admit that they found evidence of these practices, this incentive or the discretionary commission arrangement, as they said. But then they downplayed it. In 2019, when they produced their final notice, Black Horse doesn't get mentioned, neither does any firm. And they introduced it, so from January 21, we're going to ban that practice, implying falsely that this wasn't unlawful, there was nothing wrong, right? So they produced what they knew to be a dishonestly limited final notice following that 2-year investigation. A notice that didn't even reveal the extent of the evidence I personally gave them, let alone what they themselves discovered in their 2-year investigation.
Investigation took 2 years, and it wasn't until January 2021, nearly 5 years after Paul had first been in touch, that the FCA finally banned discretionary commission arrangements. It found that the wide discretion given to brokers to set the interest rate gives rise to conflicts of interest and creates strong incentives for the broker to charge a higher interest rate. It's a strikingly similar finding to the claim Paul had made to them back in 2016. We asked the FCA why it took them until January 2021 to ban the practice. In a statement, they said they were restricted about what they could say about Paul's individual case, but that the issue was on their radar in 2016, which prompted their review. They said they needed a strong evidence base to ban something, and that work takes time. The final ban was also delayed because of COVID, they said. Black Horse didn't comment on Paul Carlier's specific case, but said customers can wait for the FCA to announce their next steps. You'll hear more about that later.
Now, importantly, the BBC didn't ask them to comment on my individual case. They asked them to comment on the context of what I was reporting about the industry in general. And likewise, and I contacted Lloyds and said, right, you're going to be approached by the BBC. When they do, you've got full authority to discuss both of those individual complaints that I made to you and escalated to the Ombudsman. Full authority. So don't worry about GDPR. You haven't got to worry about that. And Black Horse took the GDPR. They knew they had authority from me, but sought to hide behind GDPR so as not to comment, and then just say, oh, we're waiting for the industry and everything else. Now, in April 17, as you just heard, they started that investigation. But we already know that in 2016, they'd buried my reports. So in February 17, when I get a DSAR response, there's an internal email from the FCA where they'd been moaning that, well, Carlier didn't send any evidence in, so we did nothing on his reports. So on the 17th of February 2017, I called the FCA number and I said, right, I'm going to send you some emails now, and you can see what I say here. And while I'm on the phone to them, I send them these emails and get them to confirm over the phone that they've received them. And I reattached everything, all of the evidence I'd given them and all the reports I'd sent to them in 2016. So, and I got them to confirm on the call, you got it all now? Yeah, right. Now do something with it. And now, is that what prompted the investigation to begin in April 2017? I would certainly hope so. They've already acknowledged that it was stuff that was on their radar in 2016. So they're intimating that someone, they did know about it. But, it's still ridiculous amount of time to get them to do an investigation.
I'm Adrian Daly, Director of Motor Finance and Strategy at the Finance Leasing Association.
The FLA is the trade body for lenders.
There were more consumers benefited from those than lost out. The dealer had discretion in some cases on the interest rate that was sold to the customer, just like the dealer has discretion on the price of the car you're buying and the price of the car you're trading in. And typically that price goes down when you negotiate. And some dealers had discretion to vary the interest rate. In the vast majority of cases, that interest rate went down when you negotiated it, but the price could go up. So in other words, that increased commission was to compensate for loss of profits on the cars. So overall, the balance may not be that different, if at all. We think it's probable that there was harm to some customers, but certainly not on a great scale.
If most of the time people were actually benefiting and it was a few, as you seem to be suggesting, that were paying more than they would have had to, why did the FCA go for the whole hog of a ban?
I think it's a question of transparency and trust. So you don't want there to be a lack of trust. You want there to be transparency and trust. And I think a world without DCAs is a better world than one with DCAs.
Right, where to start with this? Now, me and Adrian Daly have history, because now what you've heard him say there is utter nonsense. Now, and since the FCA introduced this ban, he's been all over the media. Like last year in the Telegraph, he said that no, these discretionary commission ranges were good for consumers because more often the interest rate went down. Right, utter nonsense. And I've got him on the record in 2019 after the FCA published their dishonesty limited notice. He published a podcast on which he said the FCA's got it wrong. These practices, these bad practices were, we put a stop to this in 2014 when the FCA took over regulation. So this is just nonsense. The FCA's findings are outdated. He said they were bad practices and that the FLA had put a stop to this in 2014. But fast forward to 2024 and now 2025, these are good practices. These are really good for consumers because the interest rate went down. Now, he either doesn't know what's going on in his industry or, and I'll say it here, Adrian, you're lying, right? And here's why. I'm going to show you the evidence, right? So this here is a Santander commercial agreement between them and one of their car dealers from 2013. Right, now look at it. What it says here, it shows the dealer, these are the base rates. This is what we will lend to you at, right? So this is where, 2.24, 2.74. We will lend to you that. And then there's a table that incentivizes the dealer to increase the APR up to the maximum of circa 14%. So the starting point was a low rate, a low APR to the dealer, and the dealer was incentivized to increase it, right? Now, when Plevin happened in 2014, the industry went, oh, that looks really, this looks really bad because we're incentivizing dealers to increase the APR and interest to greater profits. Bang, I know what we'll do. And this is what they all did. This is a Santander agreement from 2018. So what did they do? They reversed the starting point to start at the highest APR of 16.9% or 14.9%, as it says here. So the starting point was there. The outrageously high, and you can see the level of commission, 13.5% for the dealer. That's 13.5% of the amount borrowed the dealer is going to get if he sells these products at these ridiculously high rates. Now, what Daly's referring to is that, oh, the dealer lowered it. It's nonsense, because here's the commission table in the 2018 document, right? The incentives are still there, right? All they did, they modified the mechanics so that technically that we're lowering rates so that the customer's better. Nonsense. The customer's still worse off because the incentives still apply. They engineered and reversed the mechanics entirely to circumvent the Consumer Credit Act and the Plevin judgment, because technically they were not incentivized to increase the APR anymore. It doesn't matter. That's the incentives. This table is the incentives, right? So, and as you can see on the, it says here, if you choose to sell at lower rates, your commission will be reduced as per the table. So again, the incentives, right? But it's just absolute nonsense wordplay. Now, if Daly doesn't know that all his members, right, manipulated the mechanics of these things to circumvent the Plevin judgment and the Consumer Credit Act, then, as I say, he's either blissfully unaware of what's going on in the industry, and he's been the head of car finance for many, many years at the FLA, and this trade body is either lying to everybody and manipulating the media, because they are all over the media. the last year. It's good for consumers. It's good for consumers. When this is absolute nonsense. And so he either lied or he doesn't know his industry. And I'm going on the record with that. If that's not true, Mr. Daly, you know where to find me. You can sue me. And I've got all the evidence to make this stand up in court. Now, what else, though, is really, again, this industry was out of control, right? Now, and don't forget, this was 2018. Look at this, right? 2018, we're a year into the FCA review, and the FCA is making sure we're uncomfortable with some of these arrangements, yada, yada, yada. So what else does Santander think? Oh, well, I'll tell you what we do. We'll add this. If you look at the second bottom paragraph, the maximum commission which can be included by the dealer within the structure of any finance agreement is £1,000 plus VAT. No additional commission will be payable. Now, if the FCA sees that, and this is where I do have some sympathy with the FCA, but it also shows how out of control these lenders were. They're saying, doesn't matter, £1,000 commission is the maximum you will get. End of story. So to all intents and purposes, it's not unreasonable, right? So where's the incentive there to sell out at a higher rate if the maximum you're going to get is the 1,000? Well, that was a lie, because this is the email from Santander to that dealer, and in it, he says the commission potentially is payable on the balance to finance, and there's no maximum commission payable. So forget that clause in their agreement. If you sell a £50,000 finance at 10.9%, we'll still pay you the £3,750 commission that you're owed. The agreements were a smokescreen. The agreement's saying, oh, we're capped at £1,000, and here we have Santander telling the dealer, no, don't worry about it, mate. That's just there for lip service. It makes it look like we're doing the right thing, when in actual fact, we're not. Now, you tell me how that's not criminal. I mean, I don't know. I mean, I'm not a criminal lawyer, but that is absolutely dishonest. That's with intent to mislead the regulator, circumvent people's rights. I mean, it's absolutely outrageous.
According to the FCA's figures, banning the practice saved customers an estimated £165 million a year in interest charges. To Paul's mind, that was £165 million a year that customers should not have been paying before the ban came in. That got some, like the financial journalist and regulatory specialist Lindsay Rogerson, wondering whether customers might not be due some money back.
It always seemed to me that you put that figure out into the public and you're literally firing a starting gun for claims management and for also consumers who may pay attention to these things, thinking, well, hang on a minute, if I've been overcharged, why can't I have my money back? And that didn't happen. There was no talk of a redress scheme. The FCA said, this is what we found, this is what we're doing going forward. There was no backward-looking element at all.
People who complained to the lenders had their claims rejected. So too did those who appealed to the Ombudsman. But there was another option, the courts.
If you financed a car, van or motorbike before 2021, you could be owed compensation.
Did you know
Let me explain.
that if you enter your name and a few small details into this website, it brings up all your previous car finance agreements on screen and lets you know which one.
The free check that I've just attached to the video is going to find all your old finance agreements that you've had.
Anyone can complain to the lender or the Ombudsman, and you don't need to use a claims management company or law firm to do it. Law firms also offer to help consumers who feel they've been ripped off by bringing cases to the courts, but there is a cost, often a cut of any compensation. By this point, it was clear that the regulator believed these arrangements between lenders and dealers could have been wrong, but bringing a court case required evidence.
You had to start thinking a bit outside the box. And it wasn't until I was having dinner with my business partner that I said, what we should be doing here, we should be trying to find people within the industry, either ex-employees or people who currently work in the industry, who will almost be whistleblowers.
That's Sam Ward from Sentinel Legal, a firm that works on behalf of consumers who feel they've been missold finance. He and his team spoke to more than 30 insiders.
What they told us was that they had internal training, internal meetings, scripts, and so on, that taught them to push the finance as much as they could. If a client said that they wanted to pay cash, they had a full rebuttal script, which allowed them to deal with that as any salesperson would. From the conversations I've had with many of them, they said what we were doing, we knew it was wrong. The scripts that we were reading, we knew finance wasn't the best option for these particular individuals, but this is how they got paid. This is how they put food on the table. And this is what they were realistically allowed to do by the car finance lenders, but ultimately by the FCA.
We decided to check out what Sam says he heard by meeting a former car salesman ourselves. We're not naming him to protect his identity, and a producer has revoiced what he had to say.
We would go to the lender and they'd say to us, okay, well, the minimum APR may be 6.9% APR. We then go to the manager, they'd put the deal together, and we'd present an offer to the customer at, let's say, 13.9% APR, which was usually the offer you would start with. So they would always send you out with the highest APR possible. And if the customer is umming and ahhing with the price of monthly figures, then you would just move the APR down.
What was the incentive for doing that, for putting up the highest APR possible?
The more profit the car makes, the more percentage of the commission we'd get. And for the dealership, they would pocket all of that extra.
And it could be a lucrative business even for frontline sales execs.
When I worked there, it was a salary of 18,000, and then you'd get your commission on top, which would make you'd probably, it's like a successful car salesman, you're probably looking about 50,000 a year.
So you would regularly, as standard, make more than your base salary a year in commission?
Yeah, I never earned under my base salary in a year. So most experienced car sales execs understood that you were going to take a smaller salary, knowing full well that you were going to get like a lot more than your salary in commission.
Since leaving the industry, this former salesman says he's even put in claims for 2 cars he bought on finance himself. You might be wondering why someone who was selling these deals has ended up making a claim.
As a sales executive, you're not told these things are frowned upon. Obviously, when I went into the industry, I knew I was going to be out presenting deals that could be adjusted with the APR, but you just don't know that that shouldn't happen.
It is really interesting to hear from people who are behind the sales desk about how all this works. I mean, Phil, you've been speaking to some industry insiders. What's the phone call you just had?
Yeah, I had a chat with someone who's still working in the industry, actually, but he said he was keen for this story to get out there. He said that often customers would come into the showroom with an idea in mind about how much they could pay a month, so say something like £134 or something in that region. He said the salesman would then adjust the rate to make it £134.99, just so that they could make more commission. And in his words, he said the customer wouldn't even flinch at that.
So it's just a few pennies more a month for the customer, but over time, that all adds up.
Yeah, and when I asked him how they got to learn about those sorts of practices, he said that they were trained in dealerships, sometimes by finance companies.
According to the regulator, the FCA, 99% of car finance agreements involved some form of commission arrangement between the lender and the car dealer. The kind that we've been talking about up to now, discretionary ones, were only found in 40% of cases. But there were also fixed commission payments and other ways that lenders incentivized dealers to give them business. Paul Carlier, the man who had tried to get the regulator to look into discretionary commission arrangements, also started doing some digging on what other types of incentives dealers were being offered by lenders. He told me about how dealers would be given advanced commissions to try to push customers towards a particular lender, even if it might not be the best deal for them.
They dressed it up as a loan for your business use, interest-free, but in there were terms that you have to give us right of first refusal on X amount of finance at each given period. That's just unfair. And obviously, then that dealer, it's a revolving and loan that gets renewed every year. That dealer could then, if a customer said, oh, well, how much commission did you? Nothing. Because technically, there was no commission at point of sale on those agreements.
Armed with evidence from his own whistleblowers, Sam Ward at Sentinel Legal started to file claims in the courts. He talked me through one of the cases he'd brought.
This particular client, he had a Land Rover Discovery, which in some parts of the country is a very, very common vehicle on the road. And the total amount of finance that this particular client took out was £81,000. But within that one car finance agreement, there was 3 different commissions, which is crazy. And if I talk you through those figures now, bearing in mind the amount of credit is £81,000, the discretionary commission alone was £9,781. The commission that the head office of the dealership earned as a fixed percentage of the amount of finance was £4,279. And this bonus, just to cap it all off and put that little cherry on top, was £1,988. The total amount of commission was £16,049, paid on just one car finance agreement. 20% of the amount of finance that this client took out was paid as a commission.
I put what Sam and Paul Carlier had said about hidden commissions to Adrian Daly from the Finance and Leasing Association.
Commission arrangements took many forms. They're all caught by the DCA ban if they're discretionary in some form and are linked to the finance. That said, there have always been a range of what you might call commissions or other forms of remuneration that go, for example, from car manufacturers to dealerships that have nothing to do with the finance, for example, to build a showroom. And that's absolutely right and proper and has nothing to do with this.
Right. Point of order, Mr. Daly, again. Right. Now, you see how he twisted the narrative there to say that what had been put to him, that he talks about, there's always been loans from the manufacturers to the dealerships, you know, to help them with their branding, to help them with their showrooms. Well, that wasn't the question that was put to him, because the loan, now, the person that who was quoted there about these advance commissions being disguised as loans and the pensing up is a dealer that I brought forward. But he was also backed by a whistleblower from the lender, a former regional manager, who was actually the one tasked with going out to dealerships and giving them all these pensing up and all these other tricks of the trade to generate more money, right? Now, he was also a regional manager, like another regional manager that I brought forward from Motor Nova, who said that, and the dealers themselves will tell you as well, that if we started putting through too many agreements at a lower APR, they'd be on the phone like Ronnie and Reggie, the lenders. I'm not really happy about this. We might have to reconsider our arrangements. So in other words, it was pressure, pressure, pressure all the time. Now, Daly says the manufacturers would give dealerships loans. Well, we're not talking about dealerships loans. We're talking about a lender giving the dealership an interest-free loan for business purposes, which in fact, and we've got the testimony from the dealer, it was actually advance commissions disguised as an interest-free loan that demanded that the dealer had to put through all this finance through X amount through that finance company every month. Now, and then the loan would just roll over every year. Now, what this was brought in, this was a practice brought in 2013, entirely because the FCA was taking control of the Consumer Credit Act in 2014, and from 2014 onwards, dealers would have to disclose commissions to customers if a customer asked. I mean, a completely half-assed rule, yeah, because if you don't know that it's a commission, you don't know to bloody ask in the first place, right? So, but that was the key. So this was brought in entirely to circumvent that new rule, because as I mentioned in there, technically there wasn't a commission at the point of sale because it would have been paid in advance. So if a customer went and asked, is there any commission on this? The dig's, no, of course it's not. Absolutely, it was. I don't see how that isn't a criminal act, because the intent of that is to circumvent the Consumer Credit Act and the people's rights afforded by it, and it's blatantly false. And maybe the FCA weren't aware of that. I don't know. But in a recent parliamentary committee hearing, Rathi was asked, what does the FCA know about advance commissions? This was by Baroness Bowles, and he didn't like the question. And he clearly made it clear that he was aware of these other practices. Another practices was the volume overrides, also brought in 2013, and again, entirely to circumvent the Consumer Credit Act. What's the volume overrides? Right, so basically, the dealer would no longer get all the commission at point of sale. So let's say you're due about £1,000 commission for selling that finance agreement. What they would do is go, right, okay, we'll just call it 200 at point of sale, and then we'll give you the extra 800 as a bonus every month for every quarter for reaching certain targets. And then obviously that way, if a customer asks how much commission, oh, just 200 quid. You know, because the rest of it was, I call it backloading. So they're loading it at the back as like it's an ex gratia payment that has nothing to do with finance agreement. Utterly dishonest, and for one purpose and one purpose only, to to circumvent the Consumer Credit Act. And Dally is on there, you know, basically poo-pooing them. Just one other thing as well. Motor Novo, this was how out of control it was. Motor Novo, on their system, this is one of the big, second or third biggest lender, I think, at the time. Motor Novo even had a box on the dealer screen where the dealer puts in all the details of the application. And instead of the dealer putting the APR in, the dealer just clicked a box and said, it was asked, how much commission do you want from this? He'd put in the amount, and then that would generate the APR to go on the deal. I mean, what the hell, right? It was literally the APR was being determined by the commission that the dealer wanted. It's extraordinary. So, you know, it's absolute, Dally's just talking absolute nonsense.
And the other thing that we were told about were training schemes where sales execs would be taught by lenders to say that if something was coming out at £350 and 12 pence a month, that they would be told to quote £350 and 99 pence to increase commission. I mean, that doesn't sound very fair.
It doesn't sound very plausible either. I think that's very unlikely. Yes, I will absolutely own up to the fact that we as the lending industry spend billions in training dealerships about finance, but that's out there in the open. It's about ensuring that the people we will talk to as customers when we buy a car give us absolutely the right information we need to understand what finance options are available, and we can choose for ourselves what's the right product for us.
By the start of 2024, pressure was building. Firms like Sam's were having some wins in the courts. Complaints were also stacking up with the Ombudsman and with lenders, which, for the most part, they were rejecting. And then there were two big developments.
It's Wednesday, it's 1 o'clock, which means only one thing. Time for Martin Lewis, the man himself. Okay, Martin, this week, what are we getting into, my friend?
In January, the Ombudsman unexpectedly upheld two cases in favour of consumers, opening the way for a fresh deluge of complaints from customers. That forced the regulator, the FCA, to step in and announce a review to investigate if there had been widespread misconduct and if consumers had lost out, paving the way for a possible redress scheme to pay compensation.
Thousands of pounds.
Right. So this is critical. As you know, as you've just heard, in January last year, the Ombudsman upheld two complaints specific to incentivised commission arrangements, one against Black Horse, one against Barclays. Now, it sent shockwaves. Well, and it's been mooted about what the reason was. Now, this is in the meantime, I'm just backtracking a little bit here. My wife got better APR than my mother-in-law, 8.9%. But obviously, we knew, well, that was still missold because it was still higher than. So what we did was submit a new complaint to Black Horse, right? To, you know, well, we'll use all the evidence again and we'll force the Ombudsman to uphold it. So new complaint in 2018, the response from Black Horse was identical to the one before, packed with the same false representations. Your APR was determined by the credit score obtained from Experian. And the dealer did set the APR, but they can't manipulate it beyond the parameters we set, because the dealers and the lenders were saying, oh yeah, we would determine the APR on an individual case-by-case basis. Nonsense. These were the same generic bands. So we had this complaint in train in 2018. And on the 4th of March, 2019, the FCA announced their final notice, dishonestly limited, but they mention that these practices are in train. So I go back to the Ombudsman and say, right, you, as limited as that notice is, it confirms these practices exist and are going on, so you've got to reopen the complaint. And 2 weeks later, the senior Ombudsman came back and said the FCA final notice was not sufficient new evidence to reopen that complaint. I mean, it's a 2-year investigation by the FCA, but not sufficient new evidence. So I made a complaint against him, dishonest, conflicted. And during the calls, I said, well, let's see how you now deny my wife's complaint, my other complaint that I've got in train. I didn't say it was my wife's. So, and here is an internal email dated the 5th of April. Now, this is significant. It will be more significant on Monday when I go into real detail about what's going on. But this is an internal email from the guy that refused to open my mother-in-law's account to a group of senior ombudsman managers who were a stakeholder group. Now, at the bottom here, he says, one other thing he mentioned was that he raised a similar complaint about a car finance agreement with Black Horse. This case will be caught by the red flag, and any correspondence will be highlighted to the stakeholder team before being issued. Now, the red flag. What do you think the red flag means on the ombudsman systems? I now have it from 2 ombudsman sources, both of them on the record, both of them, I've got the recordings of these statements. The red flag is a predetermined outcome that's been established with the FOSS by the FCA. The FCA have told the Ombudsman how they want these complaints to be dealt with. And in 2019, they told the Ombudsman, deny all these complaints. And the red flag captured these complaints and diverted them to this stakeholder team. Now, I'll go into more detail on Monday with the evidence I've got to prove it, but they denied my wife's complaint in August 2019. When I did a DSAR, they sent me way too much. I was entitled to it, but there's no way they would have meant for me to have it. And we can see that on the 28th of February 2019, 2 days before the FCA notice came out, the adjudicator upheld my wife's complaint because obviously all the evidence. This group of stakeholders, it was the complaint, before she could send it to us, it's captured by the red flag, goes to this senior stakeholder group, and I've got all the emails where they put pressure on her and her manager to reverse that decision and deny the complaint. Now, I'll go into more detail on Monday, but the last year when the Ombudsman upheld these 2 complaints and the FCA went, oh, this is news to us, well, we should have to do a new review, implying that this was a decision unilaterally taken by the Ombudsman. I've got evidence to prove that the FCA told the Ombudsman to uphold these 2 complaints so that then they could feign this ignorance, do a new review. And the reason being was that in July 2023, after the FCA buried it in 2019, I took it to lawyers to see if they could do anything with all the evidence I've got. They couldn't believe what I had. And here's the briefing memo from Scott & Scott, the law firm, that they took to litigation funders. And I've redacted all the confidential stuff, but this is, as you can see, they worked alongside me. The complainant who first brought it to the FCA's attention, and I shared with them all the evidence I'd given to the FCA. They couldn't believe it, and it took ages, but in July 2023, they filed a £1 billion class action against Lloyds, Santander and Motonovo, and at the same time wrote to the FCA asking for all their information from their 2-year review. Now, this class action, obviously they knew it was all based upon my stuff because they'd asked the FCA to, we understand Paul Carlier sent you this, and well, this was going to expose, and I'm going to say it now, the largest single fraud by a UK public body that has been committed against millions of consumers. And that was what the FCA did in 2019 when they dishonestly produced that dishonestly limited final notice, right? That protected the firms, no redress for consumers, right? This class action was going to expose all that, because how does the FCA explain that we've got all this evidence, this class action, £1 billion class action brought in the civil courts by these lawyers based upon all my evidence, and the FCA didn't know or didn't take it? And we would obviously be exposing that this was all presented to the FCA in 2016 and they buried it. So their fraud was going to be exposed by the class action. That's why they told the FOSS to uphold these 2 complaints last year to kill the class action. Because obviously once they announced that, oh, this incentivized commission arrangement, yeah, we're going to, and very quickly they said it's going to be redress for everybody. So this redress scheme was basically going to give all the class members of our class action the redress that our class action was going to give them. So our class action was stayed and is still stayed because obviously there's no point in proceeding if everyone's going to get the redress now from the FCA redress scheme, right? But make no mistake, the FCA didn't take first of all, the Ombudsman didn't make those decisions. They were told by the FCA to uphold those complaints. Then they could feign this ignorance. Oh, well, this is news to us. We better do a new review. And they go, oh, we've just found this new stuff. Nonsense. There's nothing the FCA knew in January 24 that they didn't know in February 2016 when I told them. And there's definitely nothing they knew last year that they didn't know in March 2019 when they produced that dishonestly limited final notice. Make no mistake about that. So, and what's more is last year Barclays appealed that the Ombudsman decisions. They applied for a judicial review in the High Court, and the FCA intervened on the Ombudsman's behalf, and they published this document. It's a detailed grounds document that was submitted to the High Court last year to defend and support the Ombudsman's decisions and deny Barclays' claim. Now, this hasn't been published anywhere. I was lucky enough to get it directly from the court. It's an amazing document. It's a tour de force. I'm giving the FCA credit. This document is superb, the way it's drafted. Basically, Barclays' argument was that you only banned these in January 21, so that was a new law being brought in, or a new code. So therefore, anything we did before, it can't be held accountable to that. That would be retrospective. And you've heard this word retrospective all over the press and everything else. This is their nonsense position. In this document, and I've got the whole document, the FCA say that's absolute nonsense. The ban that we introduced in January 21 was not a new rule or law. It was necessary further clarity and guidance that was required because all of you lenders have been systematically breaching long-standing law and regulatory codes dating back to 2007, all of which is corroborated by the Plevin judgment. Bang. Basically, everything I told the FCA in February 2016, right? They literally put it in this document, and it's beautiful. It's a fantastic document, right? And why? So the key thing here, this proves the dishonestly limited notice in 2019, because if in 2024 they're saying, no, these incentivised commission arrangements were a breach of long-standing law and FCA codes, regulatory codes dating back to at least 2007. Well, why did you not say that in 2019 then? Why did you not? Because there was a mandate, no more redress schemes, and they did it to protect the firms and deprive millions of consumers of the redress they knew they were owed. That document confirms it, and that's why they've not published it anywhere on their website. It's keeping a low profile. And this document secured a massive verdict in their favour. The High Court chucked, the FCA and the Ombudsman won on all points, and Barclays, got kicked out. They're now appealing it to the Court of Appeal, which has been stayed because of the Supreme Court judgment. But let's look at, just before I move on, let's look at the Supreme Court case and the Court of Appeal, the appeal that Barclays are bringing in the Court of Appeal against this decision, on the incentivised commissions. They're claiming, oh, it wasn't unfair, it wasn't there. But Barclays, all the lenders and the FCA know that there were 3 other unlawful, if not criminal practices that the lenders and the FCA have concealed from everybody, right? So are they not committing perjury in court by saying, oh no, this is outrageous, it's not, these were not unlawful, whilst concealing, and they know about these other unfair, if not criminal practices that have been buried by the lenders and the FCA? I mean, I don't know, is that not perjury? So let's carry on a bit.
This is going to be the second biggest mis-selling scandal in UK history after PPI. It is predicted up to £13 billion will be paid back. It's new. People haven't heard of it. If you were missold, you will not know you were missold. You need to spread the word to anyone you think is affected. And that is
all the FCA. Right. This is new. Nobody knows about it. This is February 24. Right. No, I knew. I told the FCA in 2016. And the FCA knew in 2016. This was new to most individuals, and the FCA thought they'd got away with it in 2019. Buried it, and there's other redress schemes that they've also buried as well. But they were forced into action by the class action, and they had to take this step to kill the class action that was going to expose what they did in 2019. Right. So this is no surprise to me, no surprise whatsoever.
Investigators, they gave firms another 9 months to respond to customers who had brought complaints directly to them. But the floodgates had been opened. Martin Lewis's money-saving expert website told us more than 3 million complaints have been raised through a tool they created to help customers. And complaints piled into the Ombudsman too. They told us they currently have 100,000 on their books. Lenders started setting aside hundreds of millions of pounds for the potential cost of payouts.
half an hour. And that's after Moneybox with Paul
And then in
Lewis.
October 2024, as if things couldn't get any worse for lenders.
A surprising ruling by the Court of Appeal could mean compensation for millions of people who bought their cars on finance. And carers.
Last autumn, the Court of Appeal found that any commissions paid to dealers that customers didn't know about or consent to, like the one Sam uncovered with the Land Rover, could have been unfair, massively extending the potential for compensation claims.
I think it would be fair to say it was a shock. Out of a range of possibilities, this was on the extreme.
Back to Wayne Gibbard, the solicitor with Shoesmiths who advises lenders. He told me the ruling meant that car salesmen owed something known as a fiduciary duty towards their customers.
A fiduciary, if we think about that in our usual daily lives, would be something like a doctor or a director towards a company, and dare I say, even a lawyer towards their client. So actually having a fiduciary relationship is quite a high bar. It really holds out a special arrangement where somebody's acting in your sole best interest. And what the Court of Appeal have found is that the dealer is effectively wearing two hats. So somebody moving into a dealership will conclude an arrangement, a deal for the vehicle. And once that's been done, they will then change hats. So acting as a vendor, acting in their own interest to sell the vehicle, they then change hats to then act on behalf of the customer exclusively in this fiduciary relationship, i.e. something of confidence and trust. And that switching of hats, they then work on behalf of the customer to source the finance. And there's some tension, I think, around that the dealer midway through this transaction is switching hats rather than this being a unitary arrangement for the acquisition of a vehicle, including finance.
The regulator, the Financial Conduct Authority, said it thought the ruling went too far. The National Federation of Franchise Dealerships, which represents motor dealerships, said it misunderstood how a car sale works and what a dealer's role is. The judgment was almost immediately challenged and taken to the highest court in the UK, the Supreme Court, just opposite Parliament, to make a final ruling.
Now, obviously, much is being made about this, but again, think about it. All the Court of Appeal had before them, and all the claimants had before them, was the disclosure or non-disclosure of a commission arrangement, right? They had no knowledge about the volume overrides. They had no knowledge about the advance commissions disguised as loans, right? And they had no knowledge of another one, the stocking facility. There's another one I forgot to mention earlier. So basically, in addition to the incentivized commission arrangements, these lenders would give the dealer, don't use your money to buy your stock. We'll give you an interest-free loan. You go and buy the stock on that, but in return, you've got to put through X amount of business with us before you, at the expense of everybody else. And obviously, you can get away with whatever rate you want then. And obviously, you're incentivized. That's when the incentivized commission arrangement kicks in. So you as the consumer can't escape that. So, you know, everything that's before, the Court of Appeal got it right, but didn't know how right they got it. And all these lenders know the Court of Appeal was absolutely right, because how the hell can you argue that the relationship is fair when you're concealing these other practices? Absolutely astonishing. And the Shoesmiths lawyer even knows that these other practices are going on, or again, maybe his clients have misinformed him to give him plausible deniability.
Now, this is where I got really interested in this story. So in my day job, I'm a political correspondent here in Westminster, and I keep a close eye on what's going on with the government. The Court of Appeal judgment set off jitters, not just in the industry, but in the Treasury too. Now, bear in mind that this is a government that has made economic growth its #1 priority, and financial services is a big part of the UK economy. So any significant hit to the banks through a compensation scheme or wobbles from investors about being in the UK could have an impact on them.
I silence the Chancellor of the Exchequer, the Right Reverend, Right Honourable Rachel.
Less than a month after the ruling, the Chancellor Rachel Reeves gave a speech to business leaders at London's Mansion House.
I've also heard from many of you that our approach to redress can cause uncertainty and be a drag on investment. So we have worked closely with the FCA and the Ombudsman to develop a new agreement between the two institutions with clearer expectations on how they cooperate, including on historic market practice and mass redress events.
We're pleased today to have in front of us 4 of the largest banks in the UK.
It was a point that the boss of Lloyds, which owns the UK's largest car finance lender, Black Horse, was keen to impress upon MPs on the Treasury Select Committee in May.
This kind of uncertainty where we have 30 years of regulation, where, for example, the Court of Appeal seems to be at odds with 30 years of regulation, creates massive backward-looking uncertainty in investment in the industry, and actually real uncertainty around investment in the UK more broadly.
In fact, the Treasury was so worried it took the unusual step of asking to take part in the Supreme Court case. Its application was denied and the full document hasn't been published, but we've managed to get hold of a copy, and there are a couple of striking bits. So let's have a look. It says that the court's ruling has the potential to adversely affect the United Kingdom's reputation as a place to do business, with a consequent impact on economic growth. So that's what we've just been talking about. A bit further on, it says the industry plays a key role in supporting lower income consumers to buy vehicles, which many would be unable to do if buying a vehicle outright. And it warns it could impact the availability and cost of motor finance to consumers.
Right, let's just pause that for a minute. They're saying that make cars, how will lowering the APR and removing these unlawful practices make them less affordable? They, by definition, make them more affordable. It's utter nonsense. And Charlie Nunn, when he's making the UK uninvestable, and he says that the courts and that these decisions are retrospective. They've just overturned 30. No, they haven't. The Consumer Credit Act's been around since the 90s, right? And everything is established. All of this was long-standing law and code. Nothing's retrospective. And if your firm, Charlie, and all your mates in the car finance world weren't guilty of these egregious practices, there wouldn't be a redress scheme now. And obviously, there wouldn't be such a significant redress scheme had the FCA not buried it at the whim of the Treasury and the lenders in 2019.
So is there anything in here about the redress scheme? It says that if there was a redress scheme, the Treasury would seek to persuade the court that any remedy should be proportionate to the loss actually suffered by the consumer and, now this is interesting, avoid conferring a windfall upon her. So this is what the Treasury actually submitted. We've got hold of this document. This is their. In a corridor in Parliament, I shared what we'd found with Liberal Democrat MP Bobby Dean, who was first elected last year. He sits on the Treasury Select Committee and has been campaigning on the issue.
I worry a little bit that what the government is too keen to do at the moment is show industry that they're on side all the time and how they're going to have this deregulatory drive and so on, and starting to forget about the consumer. You hear this a lot with their kind of growth versus regulation talk. I don't think it should be a battle between the two. We should be able to regulate well and achieve good growth. So yeah, it's worrying reading this. I mean, of course, any redress needs to be proportionate to the harm done, but they intervened on the basis that this might impact on the economy somehow. I think that sets quite a dangerous precedent to say that we shouldn't have consumer redress because of the potential impacts on the economy.
And if you look down at the bottom, you've got the bit about redress here, where it says this line about seeking to persuade the court that any remedy should be proportionate to the loss actually suffered and avoid conferring a windfall. What do you make of that?
Well, I think they should trust the regulators to do their job and apportion a fair and reasonable apportionment anyway. There's lots of different ways that you could calculate it. You could say that the entire loan is invalid, or you could say that part of the interest element is invalid. I think that the regulator will come to a sensible conclusion on that. So I think they should trust the regulators to do their job.
We did ask the Treasury if they wanted to talk to us, but they said it was appropriate to let the appeals process run its course. They sent us a statement which says they want to see a balanced judgment that delivers compensation proportionate to losses that consumers have suffered and allows the motor sector to continue supporting millions of motorists to own vehicles. This has been an issue that has been long in the making. Some of what happens next will depend on what the Supreme Court rules. Back in Kent, Paul Carlier will be watching closely too. In March this year, he received 2 letters from Black Horse about complaints he'd made about his wife and mother-in-law's finance deals. He told me what they said.
Our checks have revealed that, yes, both of these agreements were sold subject to an incentivised commission arrangement. That was the 18th of March this year. That's 13 years since I first complained about the APR being incorrect and inappropriate, and obviously 10 years after I'd got the evidence as to how these things had applied.
He still hasn't been told, though, if they're in line for any compensation.
What's it doing to the financial services sector now when all of this is now coming out? We've forced it to come out and we've forced you to do all this. What does it say about the regulator as well as the industry? You know, it's not a good look because millions have been damaged by this, millions. The true scandal has still not fully been told.
In a statement, Black Horse said, "We welcome the Supreme Court's expedited hearing and hope it will bring greater clarity and certainty. Customers don't need to do anything right now as complaints are subject to the FCA pause and can wait for the FCA to announce their next steps."
The Supreme Court ruling is expected any day now, and the Financial Conduct Authority says it will set out if there will be a redress scheme within 6 weeks of that. Any payments of compensation, though, wouldn't start until 2026.
So this is where our road trip ends. The fallout from how car finance has been sold in the past, though, still seems to have some way to go.
That's it. Now, you heard there that on the 18th of March this year, Black Horse responded to us, because after I got this FCA detailed grounds document, which basically confirmed everything that I bloody told him in 2016 and everything I'd alleged to the FOSS. I'm nearly done here, Andy, so like literally 30 seconds. I made a new complaint, a joint complaint to the FCA, the Ombudsman and Lloyds, accusing them of various egregious and unlawful conduct, both individually and at times collusively with one or other of the other parties. And it was that complaint, and I included the FCA detailed grounds document. It was that complaint that the Lloyds responded to from Charlie Nunn's office themselves. And it says, here we go. Based on my initial checks, I found that Mrs. Bryan's finance agreement involved a discretionary commission arrangement. That's my mother-in-law. That was 13 years after I first complained and 10 years after I got the evidence to prove it. And then the same for my wife. Right now, I then took these to the Ombudsman and said, right, there you go. That is a confession that they missold these agreements, but it's also a confession that they lied to us in the complaints process and they lied to you when we escalated it to you, notwithstanding the fact that you were happy to go along with that and lie to us and buried it. The Ombudsman have now attacked me. They've gaslit me, claiming that I've made unfounded allegations against them and that they will not be reopening those two cases, even though that I've got these two confessions, right? How is it the Ombudsman then, Lloyds have confessed, your decision is wrong. You have to, no, they are trying to bury that and bury me along with it. We're not having it. We're not having it, and this will not be the last of it. We've got evidence of misfeasance in public office now, and if they do not settle, we will take them to court, and and we'll get the justice that we're owed. Because when the Ombudsman did what they did and buried this, it gave Black Horse a green light to up the ante and up the misconduct against us. I mean, it's extraordinary, and they were just clearly emboldened. Well, what are you going to do, right? And that's the other downside of bad regulation. I'm just going to finish here, Andy, and this is ahead of Monday. I want you to. This is a question that Siobhan McDonough asked the Ombudsman, CEO and chairwoman in February of this year. She refers to my complaint, right? That, and says that, well, why were these complaints denied in 2016, right? And, are you aware of the complaint that I'd submitted on 31st of December to the CEO of the Ombudsman, FCA and Lloyds jointly? Mr. Dipple Johnston, the acting CEO, he says not sure, he'll get back and everything else. But then Siobhan follows that up with this question. Lastly, did the FCA at any time since 2016 put pressure on your service or indicate or direct you as to how it wanted you to deal with unlawful incentivised commission arrangements? He said no. He said no. And I've got either the two senior managers at the FOSS are lying to me when they told me, and I've got it on the record, that in 2016 and 2019, the FCA wanted us to deny these complaints, but in January 24, they told us to start upholding them. Either they're lying or Mr. Dipple Johnson just lied to the Treasury Select Committee. In that now, I understand that's under oath, isn't it? And that would be contempt of Parliament. but I'll tell the full story of this, the Ombudsman role, on Monday. So that concludes it, Andy.
That's it. Ladies and gentlemen, can I please invite you to join me in thanking Paul for that? That was a remarkable walk through a mountain of detail that, frankly, I think only Paul Carney could do. Honestly, Paul, you really are absolutely unique. We're all indebted to you. I have a suggestion, folks. What we're going to do, we're going to keep the recording going. I stress this point. We're going to keep the recording going. We're going to take literally a 4-minute comfort break. Okay. Then those that want to return, and we'll have a bit of a Q&A discussion. Okay. Because I think some of you will want to share your thoughts on what we've learned so far tonight. Also, I'm going to share my screen to draw your attention to a couple of important things. Okay. So bear with me while I do that. So, there's a very good piece in the FT by Martin Arnold. This goes back a couple of weeks. And as you can probably see, the headline in the article is Minister Promises to Curb Powers of UK's Financial Ombudsman. And I'll circulate these slides. And Paul, if we can, we'd love to circulate your slides too, if you're happy for us to do that. But I'll definitely circulate these slides, and you'll see here I've put a link to the article. Read the article. What it talks about is the idea that at the Mansion House speech taking place on Wednesday of next week, there is, it would seem, an interest within government to change the way the financial ombudsman works. And the question I'm posing, as you can see at the top of the slide, is consumer protection in jeopardy? Are we likely to be hearing a speech by Rachel Reeves next week that indicates the direction of travel is to change the way the financial ombudsman works? And if so, might that lead to an erosion in consumer protections? We think there is a chance that might be the case. We don't know, but we think it might be the case. So next week, we've got a special event taking place on Thursday next week at 6 o'clock, which is about the question, how do we respond to the Mansion House speech that will have been delivered the day before? Okay, so next week, come to the Monday 6 p.m. session to hear part 2 of Paul's delivery, which has been stupendously good. Paul, thank you so much. We also have an event, if you like, a standard TTF event on Tuesday evening next week. Then come to this special one about the response to the Mansion House speech on Thursday of next week at 6 p.m. You'll get all the details in the Transparency Times and other comms from us. Folks, I propose we have what is now a 2-minute comfort break. If you want to come back for the conversation we're about to have, and we'll invite people to chip into the conversation, then please do. If you want to leave now, that's obviously down to you. But can I please once again invite everybody to thank Mr. Paul Carlier for being Mr. Paul Carlier and doing what only Mr. Paul Carlier can do. Thank you very much indeed, Paul. Well, I'm very pleased to see so many of you decided to stay for
Can I just quickly share something?
Conversation. Of course you can, Paul. Of course you can.
Basically, I'm just going to share something. We talked about the Mansion House speech.
Yeah.
So, can you see that there?
Yeah, we can.
This is the UK Finance submission and response to Rachel Reeves and the Treasury, and this is all there, and this is what they've been lobbying for over a year. And they've said that we've been liaising, and as you heard earlier, that the Treasury said they've been working with the industry and everything else to lobby. Now, what they've done, and they're reforming the way the Ombudsman operates, right? This is in that document. They say, we have therefore greatly welcomed the attention from the government on reform of the Financial Ombudsman Service and the need to address the fact that decisions that go beyond the FCA rules create legal uncertainty and see the Ombudsman acting as a quasi-regulator. They are falsely and dishonestly using the decisions made by the FOSS last January as some sort of evidence that the FOSS made those decisions and the FOSS is acting as the regulator against the wishes of the FCA. Well, I've got all the evidence to prove that the FCA told the FOSS to make those decisions. So UK Finance, and they know this, UK Finance are not stupid, right? They know that those FOSS decisions were not made by the FOSS, but they are trying to leverage those decisions to paint the Ombudsman as a regulator in an attempt to force the government to take further powers away from the Ombudsman. You couldn't make this shit up. Sorry, pardon my French, but it's astonishing. Absolutely astonishing. I'll leave it there.
Paul, again, thank you. My goodness me, there's so many facets to this, isn't there? Just to kind of remind everybody, all we want, all Transparency Task Force wants, all Paul Carlier wants, presumably all the parliamentarians want, is for the financial sector to be well behaved, run ethically. When people misbehave, for the regulators to deal with them properly. That's all we're asking for. You know, I don't think anybody's asking for anything unreasonable here. And of course, we have to remember that every time there is some kind of malpractice in the sector, not only does it hurt the people that it hurts, for example, people who've ended up paying, well, let's put it this way. You might have ended up with enough money to buy, let's say, a Vauxhall Cavalier, for example. Do they still make Vauxhall Cavaliers? Whereas had you got the right car finance that you should have got, you could have had a BMW something or other. Do you get what I'm saying? You know, people have been driving around in Vauxhall Cavaliers, metaphorically speaking, but they could have been driving around in BMW something or others. Or putting it another way, they could have had another £100 a month or week, whatever, to pay for extra food in the house, to give the kids a holiday that they wouldn't have otherwise have had. This is the real human impact of what happens when people are being ripped off. That's why these laws exist. That's why government's there, to protect us. You know, the first duty of a government is to protect its people. And that's not just from armaments being flung at us from some faraway country. It's from people ripping us off. We're not asking for anything unreasonable. I'm absolutely sure nobody's asking for anything unreasonable here. We're just asking to be treated fairly. Yes, please, Paul.
What we're asking for is for these firms to act with honesty and integrity, which I think you'll find is the cornerstone of FCA authorisation.
So I think we've got so many stories here. There are so many facets to it. The big question for me is not, has there been something going wrong here? That's pretty damn obvious. But the real question is, does the industry, the regulatory framework, the hierarchy of oversight, as Paul calls it, does it behave properly when it realises something's gone wrong? Or does it try to bury it? And if it does try to bury it, who's involved in burying it? I'd welcome any comments and questions. Nigel Cairns, you're a man who I know has some pretty clear opinions about failures in the system here around Parliament not making the regulators do the job that they ought to be doing. I mean, we're not here to pick on anybody or to give any particular part of the system a hard time. We're just trying to understand what the hell's been going wrong here and what needs to happen to sort it out. That's all we're asking for. Mr. Nigel Cairns, please do get our conversation going, if you'd like to, with any comments that come to your mind.
Okay, well, I think it's pretty telling that Mr. Rathi was recently given a renewal of his contract for another 4 years at the FCA. Now, it's the government that has sole jurisdiction to appoint or to remove the CEO of the FCA. And I think he's there for a very good reason, that they can't afford anybody else to go in there at this very difficult time. And I would point to the concerns at the Treasury and their previous involvement, and with previous involvement of governments, various governments, Labour and Conservative, going back over a considerable number of years, that have all got skeletons in the cupboard, and they're all of one mind that none of them want any of this to be exposed. And I think it's a super massive cover-up across Parliament. I don't think all parliamentarians are involved in this, but I think there are a number of them that wish for the powers or the difficulties that we're seeing at the moment with all these exposures, thanks to Paul Carlier and TTF. They don't like it. We're getting the upper hand. We're exposing them. And they're trying to shut it down in whatever way they can. But they won't be successful. They're just going to, the thing's going to explode, I think, in due course.
Do you think so, Nigel? Do you think eventually all the truth is going to come out, and then eventually people will realise there's been an almost
Yes, I think it will have to. Too many people are losing faith in the democratic system as a whole because of these problems. It's not just confined to the public body, that's the FCA. People's concerns. This is why we're getting other parties and splinter parties appearing, because of the massive distrust collectively in the establishment. And I think we're seeing the very worst of it in the relationship between the government, the FCA, and the Treasury at the moment being exposed. And also, we're also seeing the massive power that money has in terms of lobbying of UK finance that are pulling all the strings. I think fundamental corruption is running very deep throughout this whole sad story. So,
Nigel, thank you very, very much.
I'm sorry if that's a bit sort of doom and gloom, but I think it's best to sort of try and that's my best realistic assessment of the current situation.
You've said a lot there, Nigel. It's actually very, very interesting to me. Folks, some of you may or may not be, well, some of you may know about this book, others may not. Andy Verity, the BBC's finance and economics correspondent, wrote a book called Rigged. As you can see, it says it's about the incredible true story of the whistleblowers jailed after exposing the rotten heart of the financial system. And there's all sorts of great comments about at the back from all kinds of people, from Jeremy Paxman, from Victoria Derbyshire, etc. Okay. The reason I mentioned the book is because Nigel just mentioned the talk about there being almost like collusion, for want of a better phrase, between the government, the banks, and the Treasury. And if you read Rigged, which is not a novel, it's a proper research book. If you read Rigged, you can understand how innocent people actually ended up going to jail because of all the power behind the scenes. That would be my way of describing it. And I can certainly see how the dynamics around this car finance scandal are such that the industry, the regulators, the City of London might want to do all they possibly can to minimise the consequences. The problem is this: if in the process of using tactics and strategies that do minimise the consequences for them in the short term, nothing will ever change. And there'll be another car finance scandal or PPI scandal or global financial crisis or something such thing in the future, because the system is failing to learn from its mistakes and its errors because it's all being covered up. Thank you, Nigel. Mr. Neil Taylor, please, if you wish, feel free to share any thoughts that you might want to. Just to again keep this conversation going, I'll go to Paul Birch after Neil Taylor, just to sort of see what others think. Neil, anything you want to say?
Yeah, I pick up on what Nigel says. I think there is a state of failure in government trying to, there's one thing after another going out there, and some things are just failure of management or failure of, or corruption even. You don't know, but there are massive failures. They're not small failures. HS2, for instance. I mean, I don't understand how we can spend so much money wasted by a government, starting with Labour, then it goes to the Conservatives, and they realise this thing's totally out of control, and this is huge amounts of money. And this is not just one thing; it's several of those. I mean, the PPE scandals that are going on. Where's the resolution to those? We need to know that. The people need to know the answer to these things, and the car finance one as well. If it's as big as this, they've got to come clean and solve it. Like the post office one's coming clean. It's the only one that's coming clean after so many years. It might be 50 years on before it happens, beyond our time. But I think they can only deal with so much scandal in one time, and they have to bury everything else, don't they? That's the problem.
Yeah. Neil, thank you very, very much. Thank you. I think you're right. I think what you said, Neil, is right. I think what Nigel said is right. It seems there is a systemic issue here, a general lack of transparency, truthfulness, and trustworthiness, a general collapse in standards of conduct, in corporate governance, in regulatory efficacy. There's a long list of things going wrong. Thank you, Neil. Thank you. Mr. Paul Birch, I'm very aware that you've had some concerns about the sort of systemic failing of the system. Your reflections on what Mr. Paul Carter has shared with us tonight.
Well, basically, everything that Paul has said, I can second, and I have, like Paul, built over the last, well, since 2016, thousands and thousands and thousands of pages to substantiate my allegations, and they mirror almost exactly the same things that Paul has come up against with the FOSS, the FCA, the SFO, and many others denying any responsibility. And I think that is the problem that we face, is that we all know what is going on, but you then get the likes of Nicola Raffy, etc., appearing before various parliamentary committees, and they just get up and, without putting too fine a point on, are economical with the truth. They will swear that they had no prior knowledge, and as Paul has evidenced, they have had knowledge. My UK lawyers wrote to the FCA in June 2019 with a long list of breaches of the FCA rule of conduct committed by FCA regulated entities, and they have just tried and continue to try to bury it. My Cure Ops group, for want of a better term, is even worse in that there are multiple jurisdictions involved, most of which sadly are former British colonies or whatever, and they just want to push the can down the road. So the SFO have acknowledged that fraud is involved, but they say it's not something we can get involved with. You need to take it up with the authorities in Malta and the Isle of Man. I've got that in writing. As lots of you perhaps know, I've been involved in a litigation case in Malta since 2018, which is still in its preliminary hearing stage because they will not admit any liability. And there are 3 separate class actions being brought against Isle of Man insurers where these insurers have paid secret commissions to financial advisors and others. And as Nigel Cairn says, this thing is huge. And I truly believe that if the truth is ever allowed to be fully exposed, the financial implications, not just in the UK, but throughout the Western world, will be such that, you know, it'll be like the great crash all over again. I truly, truly do. You've got banks involved, you've got insurers involved, you've got the awful big auditing companies have been signing off audited accounts, knowing that the statements in there are false. It's just, it's unbelievable. It truly is.
And as thank you very much indeed, Paul. As Nigel indicated, if people feel that things are bad, things are broken, they will think about voting in a manner that they may previously not have considered because they just don't feel they're being listened to. I mean, TTF is a completely non-party political organisation, but it's pretty obvious there's a particular dynamic going on right now where it seems frustration is causing people to change the way they think politically and change who they support politically. Who knows what that might bring? So this is I hope something that does not get ignored. You know, we're doing all we can to make parliamentarians aware, make key people aware of what's going on here. We got an event on Tuesday night. I think the title of it is Willful Blindness. I really hope to goodness that the authorities, the powers that be, don't have a bout of willful blindness in relation to what's being exposed. And if they do, they're part of the problem. They're part of the problem. Please do come in, Paul. Please do. Thank you.
There's no legal aid anymore, right? So you've got nobody's got access to justice. We took this just to let you, after the Ombudsman and the FCA buried it in 2019, we went to a law firm to see about taking civil action against Lloyd's, Black Horse, and the Ombudsman, because we had the evidence of the collusion. Like the Ombudsman had upheld it and then dishonestly reversed the decision. They said, and it was £4.5 grand. That's what we were looking for. That was what we'd calculated as being the difference between the interest she paid and the interest she should have paid. They told us, unfortunately, it won't be a county court claim because they'll say it's too big for that, so it'll go to the High Court. So you'd need and then they would KC up. So you're talking about potentially £50,000 in legal costs for you, because we'd have to KC up as well, and I think it said £70,000 to £100,000 in potential legal costs if you lose. And we'll go, sorry. So we've got to risk 150 grand to bring a £4.5 grand claim. What the hell? So, and the irony of it is that means that you've never been more dependent on the free and objective, supposedly independent services within the hierarchy of oversight, like the Ombudsman. But, all evidence to the contrary. So at a time when you've never been more dependent on them, it's never been more corrupt. You're done. I mean, it took me 13 years to get Lloyd's to confess to mis-selling that agreement. 13 years. I know what I'm doing. I'm as experienced and as sophisticated as it comes. I spent 28 years as a trader in the world's largest banks. I know if it takes me 13 years, what chance anybody else got? That's the really scary thing.
Amazing. Thank you so much, Paul. Thank you so much. If there was any kind of justice in this world, you'd end up being knighted or something. You probably won't, Paul. You probably won't, but you should be. Nigel Cairns, please do chip in, and then we'll go to anybody else that wants to share any thoughts before wrapping up. Nigel.
No, Paul's absolutely right. The biggest single weapon that the banks have and have been using on an increasing scale is intimidation through adverse costs in the courts. It's basically still the Dickensian situation where those with the deepest pockets win, because even if you were able to win against them, you know that you can be subject to further hearings and appeals, and sooner or later the courts are likely to say or be forced to say that unless you can prove that you can pay the costs of the other side, then you've got to pack your bags and go. And this means that the basic human right, the right for both parties to be heard, is being suppressed through illegal means, because, as Paul said, there's no legal aid and there's no equality of arms in the justice system, and that is being exploited by the banks to the nth degree. And it's subverting democracy, basically.
Thank you. These are big issues for society as a whole. They really, really are. I guess the question we all have is: do we stand by or do we stand up? And we think it's worth standing up, even if we can't make things better. At least we know we'll try. I think the situation is totally intolerable. Thanks, Nigel. I think Joseph wants to come in. Is that you putting your hand up, Joseph? Yes, it is. Please take yourself off mute, Joseph. You're on mute. So you'll need to take yourself off mute somehow.
Okay. Andy, I'd like to give you a statement of 20 years ago that applies not just here in Canada, but around the world, dealing with our banks and financial institutions.
Yeah.
If I may be humble, I was nominated in 2002 for the annual Nobel Award in economics. And my thesis, investorism thesis, involved point-of-sale education for financial consumers of mutual funds, a one-page document that I've shared with you, Andy, and it was for the consumer investor to fill in the blanks following the ancient Chinese proverb, tell me and I forget, show me and I remember, involve me and I begin to understand. In other words, by filling in the blanks myself, it's not pre-printed. And it was timely nominated immediately after the 2001 Nobel Award in Economics for asymmetric information. Those with less education and knowledge end up paying more for goods and services than those with education and knowledge. And the corollary being, when sellers know more about a product or service than buyers, we tend to have products at too high a price. Yeah. And a year later, or on June 5th, 2005, my wife's esteemed uncle, Adam Zimmerman, the retired chairman of Noranda Forest, Macmillan Bloedel, C.D. Howe Institute in Canada, an FCA accountant. He'd been on the board of 40 different companies, including TD Bank, Magna International. I mean, he was recognized as being one of the most highly respected corporate elite in Canada because he was a truth teller. And Adam told me in front of his wife, Barbara McDougall, second wife, who had been a Brian Mulroney, 4 times federal minister in Canada, including Minister of Finance. He told me in front of her, she was standing 2 feet away from him, Joe, you're being character assassinated by Canada's Holy Trinity. Whew. Adam, who is Canada's Holy Trinity? And he said, God the Father is our chartered banks. They are all powerful and omnipotent. And that to me is something that I guess is kind of global in perspective. The banks, financial services industry, and that our government institutions, there's so many different silos. And what I've just heard today, every silo is sort of denying knowledge of complaints filed, both here in Canada and in the UK. They're denying responsibility, accountability. They're not taking action. They're leaving it to the abused to have to go through the court system and have the courts in class actions do the jobs of governments. And I share this with you because using the religious analogies, and it describes the power of our banks. And here in Canada, of course, our banks have to remain 50% owned in Canada. And that's basically our sovereignty. That's, you know, we don't have JP Morgan coming in and Bank America and all the others down there in the States owning our banks. That's our sovereignty, to have our banks owned at least 50% here in the country. And then if you look through the banks, they're all members of the Canadian Bankers Association, and they have mutual funds. They have proprietary mutual funds and ETFs. And if you look at what shares are owned by the banks, well, the Royal Bank of Canada is the largest owner of the Bank of Montreal with about 8% of the Bank of Montreal shares. And our biggest banks are all members of the Canadian Bankers Association. So they've got a collective collusion group. They can decide to vote the shares in all these funds in their own self-interest as bankers or as the association. And it's never disclosed how they vote the shares in their funds.
We can relate to the sort of thing you're talking about, Joe, big time. Thank you so much for sharing those thoughts. I'm going to wrap up in just a moment. Before I do, does anybody have anything they're itching to share before I go to Paul Carlier for any final thoughts from Paul? Please wave a hand. Yes, Digger, I can see your hand now. Please do share. Thank you, Digger.
I'd like to compliment the people who've contributed their enormous skills and energy over decades to give us these stories, which are not leading to a very satisfactory conclusion. The only people in Britain that could change any of this corrupt system are in our Parliament. And unless they are motivated to change the attitudes of the Treasury and the direction of government, we will never get a change. The banks are operating in their self-interest. The financial services are operating in their self-interest. They will pay fines. They've been doing it for a long time because it's more profitable to be corrupt and pay the odd fine than to be honest. So we cannot look to them for any ethical guidance, but we could hope that our Parliament might do something sometime.
I think that's a fantastic line of thought to end this session on, Digger. It really is. It really is. Ultimately, we do live in a parliamentary democracy. You know, people have died literally to give us the freedom and democracy that we have. And if our democracy is not functioning as it's supposed to, it's down to us, we the people, to make it change so that it does. And if that means finding parliamentarians who can actually back and support the people in the way that is necessary, has got to be the way forward. Digger, thank you so much. Mr. Paul Kiley, your final thoughts before I wrap up the session. And Paul, I know I keep saying it, and you're probably so used to me saying it that it may go in one ear and out the other. You, Paul, are a unique human being with unique abilities for attention to detail, analysis, understanding, on top of however many decades it was as a trader. It's just so fortunate that you happen to have the kind of magic cocktail of skill sets and abilities and motivations on a completely pro bono basis to try to bring the truth to service. We're all indebted to you, Paul. Any final comments from yourself before I wrap up and remind everybody about Monday's meeting? Thank you.
No, I'd say the one thing I would say is keep the faith, because if anything, this is proving that if you keep going, you know, don't get me wrong, it's been a slog to say the least, and you're wading through. It's like it's a treacle can of corruption. I mean, it's you know, there's no two ways about it, and you shouldn't have to. But there's a lot going on this year that says to me that this is changing, and we've got a few things in the pipeline as well that we're gonna, not just about car finance. We've got you know, we've got a decent group together, and we've got a few things in the pipeline that are going to, I think, make a real difference. And then we kind of change the model of approach, because it's all about money. You know, it's all about money that you're owed, and it's all about money you need to fight the claims. And we've got a few things I say in the pipeline that, fingers crossed, watch this space, and it's going to change things. And because it's not just about leveling the playing field. We're not even on the same bloody playing field as these people, right? We're on a different playing field, and we're playing by a different set of rules, right? Every lawyer I've come up against that's represented the bank doesn't give a monkeys about lying in court or lying in litigation, because that's taboo. If you accuse somebody of lying, that the courts don't like that. Even if somebody has literally barefaced lied their arse off, it's all. No, we don't appreciate that. So the courts aren't sanctioning people. You've got the regulators not sanctioning or doing anything. The regulators are in the pockets. The ICO, and this is something that needs to change. The ICO has a lot to answer for, because information rights, be it data protection rights or freedom of information, they're the cornerstone of a democracy. Right? That's what separates us from Russia or all these other countries. But at least in Russia, there's corruption, so you cut your costs accordingly. Right here, we live in a democracy. Right now, currently, if you make a complaint about GDPR, now everyone knows my approach to data subject access requests. They're our biggest weapon. But since I've started publicising it, and I've shown people how to use them and everything else, and Nigel Farage has used them to good effect, it's all changed. Now I'm getting data subject access responses that they're just absolutely and utterly unlawful. And if the ICO upholds it, and we had one for somebody the other week, they say, yeah, that's not right. We've ordered the data controller to provide a compliant response and provide that information as soon as possible, if not no later than 28 days. However, if they don't comply, we haven't got the powers to enforce, so you're on your own in court. Now, first of all, that's an absolute lie. The ICO does have the powers to enforce. because you're the regulator. You have the teeth. You can. The ICO has the power to bring criminal prosecution, so it absolutely can bring civil prosecutions, civil actions to force somebody to comply, right? But they're literally throwing you to the wolves, and all the data controllers know that, right? So what's happening? They're just going, oh, okay. So if we just ignore this, the ICO is not going to do anything. The ICO isn't going to enforce its own decisions, even though it has the powers to. Now, if you go on the ICO website now, I've had to do it recently, escalate a complaint to the ICO, you have 3 months under law in which to make a complaint about a GDPR issue, right? And the ombudsman is, I think, got 28 days obligation to turn around and deal with complaints. 3 months you've got to escalate a complaint. Go to the ICO website now. 5 months just to assign a complaint to an adjudicator, right? 5 months. Now, and the reason being is because the ICO is abdicating all its statutory duties and obligations. All these data controllers are running roughshod, leading to a deluge of complaints that is now drowning the ICO. So it's making its own bed to lie in. But again, it's a regulator that is choosing, not to regulate. And and for the information thing, that's a massive deal. I mean, Andy, I had to take the FCA and the ICO to the first tier tribunal to force them to respond honestly to a freedom of information request. And it took me 18 bloody months. I've got better things to be doing with my time. I had to take on the ICO and the FCA in the tribunal with their barristers and I won. Well, not because I'm clever, not because I know that, because, well, that's what the law says, and they've lied or they've misapplied the law. It's not, I shouldn't have had to have done that. These two bodies knew the law inside out. So this is what we're up against, but there's a lot going on. I said to somebody the other day, wheels are turning and they're turning in the right direction for a change. It's still not fast enough, but there's progress being made.
Fantastic, and you're absolutely at the centre of all of that. Well, thank you very much. I'm going to share my screen just to share some final thoughts before we wrap up. First of all, I'm going to recap on this particular slide here. We saw this slide earlier, but I just want to kind of reframe these questions again. Do you have a sense of deja vu? Of course, I was talking about the common ground between what we saw happening in PPI land and what's now happening in car finance land. Are the financial regulators guilty of the same failings in the car finance scandal as they were in the PPI scandal? You may well already have an answer to that one, and it may well be similar to my own. I personally think they are. It seems to me that it's damn obvious that the same kind of thing's been going on. Perhaps it's actually even worse, although that's difficult to imagine. If that is the case, what does it tell us about whether the regulators are fit for purpose? If part of the purpose of a regulator is to make sure the rules are being applied correctly and make sure consumers are protected and to sort things out when they go wrong, are they fit for purpose? Yes or no? And if they're not fit for purpose, does the car finance scandal pose an existential threat to them? And that's actually an interesting question, perhaps more interesting than you realise. The question's got two questions in it. Effectively, it's asking, if they're not fit for purpose, could that bring them down? But within that question is another question. If they are not fit for purpose and it doesn't bring them down, why? Why? What is it around the regulatory universe that is failing to fix things when they need to be fixed? I'll leave that one there. And my final slide is a quotation those of you who know me reasonably well know I refer to from time to time. Robert F. Kennedy. This is why people like Paul Carlier are absolutely priceless to society. And believe you me, I know Paul's right when he says he suffers doing the work that he does, bringing stuff out to the open. More than any of you will probably realise. Paul pays a price for what he does, and he does it for the right reasons, despite the price he has to pay. And for that, Paul, I will always be indebted to you, and so will many others without even realising it. Paul, thank you. Robert F. Kennedy, he could have written this for Paul Carlier. Every time we turn our heads the other way, when we see the law flouted, when we tolerate what we know to be wrong, when we close our eyes and ears to the corrupt because we're too busy or too frightened, when we fail to speak up and speak out, we strike a blow against freedom and decency and justice. I don't know about you, ladies and gentlemen, but I want to live in a world, and I want my children to live in a world, and maybe one day my grandchildren to live in a world that is free and decent and just. And that's only going to happen if we make it so. That's only going to happen if we make it so. That's why Paul's message, keep the faith, is so right. Let's thank Paul again. Let's also thank ourselves. It's been a bit of a marathon session, guys and girls. Thank you so much, Paul. Same time, same place, Monday night and Tuesday night and Thursday night. See you all next time. Thank you very much indeed. Thank you all. Bye-bye.